Big deep breaths. So let's see if we can go live on Instagram. Good afternoon, everybody. Looks like it might let us do it. New tech is funny. I think it is. I think we're up. Okay. Let me shut that down. So I don't have both of us. So I was going to have reverberations in my ears. Stephen, how do you like being called?
Steve. Just
Steve,
no end.
welcome.
Yeah.
I'm very excited about today. This is a new foray for this podcast. So far, I've spent my time talking to people that I know, that I'm interested in their story, that I want to go deeper with. And this was like a switch around where you reached out to me and I was like, oh, this has never happened to me before. So this is a first timer for me. And then I read your bio, if you like, on your book that's on Amazon, which I'm going to do a couple of excerpts for people who are listening. You go, who is this? Who is this American man on this British podcast? So they get a sense of what we're dealing with here. Because I read your bio and went, oh, not sure I can speak to this man. There's a lot going on. So I've got investment portfolio manager of, reading this because there's a lot here, 50 plus years, 44 of those managing as many as 300 individual investment portfolios around the USA and overseas. You sold your business in 2023 and you have more than 110 million under management for around 140 clients. And the thing that I found really interesting in your excerpt was that of the top selling investment book authors on Amazon, only 2 are professional investors and none have ever directly managed other people's money, which I thought was the most interesting part because the figures, they're big and most of us can't wrap our heads around those kinds of numbers. But once you get into, oh, hang on, most people who write books about money don't actually directly manage funds, then it gets even more exciting. So welcome to the podcast. Thank you for your time and coming on for our listeners. It's a privilege to have you here and to have your time. I always think when I read someone's bio like that, I go, oh, to have your time is huge. So thank you for that. I really appreciate you coming on.
You're welcome. I'm happy to be here. It's good to talk to people. I like to talk to people about what they do, what I do. So.
Yeah, it's massive, isn't it? I think there's especially in money. I've always been told, I've always been interested in money. And we were talking just before we came on. I said, I left school at 15 and school wasn't my thing, but I love learning. And I've always asked people what they earned. And I've always been happy to say what I earned, which as a chef for 17 years was not a lot. And there's this funny taboo around money where people are like, oh, you shouldn't talk about it. And you shouldn't ask people what they earn and all that. So it becomes this kind of mystery thing where we get to adulthood, think we should know how to deal with money. School didn't teach us. No one will talk about it up to a point. And then everyone's going, well, how do I do it? So it's an honor to, speak to someone like yourself who's going, well, actually, this is how you do it. And this is what I've done. And this is my career. And, it's a magic space to be. And I think it's a big gift to people that you've had this career. Like, you don't need to work anymore. You said, oh, I've retired, I've sold out. To actually then come back and share everything that you do with people, I think is, it's a big gift. You don't need to do it. So I think that's really awesome.
My wife would tell you I do need to do it.
Brilliant.
Because I get really bored. There's only so many crossword puzzles and word games you can play, and I can't stand to sit around in front of a TV. So how many times are you going to walk around the neighborhood? You got to get out of the gym. You got to get out, so this is what I know a lot about. And a lot of people need to talk about it.
Yeah. And it's huge, right? It's that. And I love that you said that because it was the same for me when I, not on the scale that you've done, but when I didn't have to work anymore at 32, it was like, what am I going to do? I'm not going to exactly what you've just said, but I think for people who haven't got there, there's this idea of, margaritas on the beach and I'm just going to chill out for the rest of my life. Like that lasts a few weeks. And then what are you going to do?
Right. So exactly.
It's brilliant to hear you say it as well, because I say it, people are like, oh yeah, whatever. You've just got loads of energy. You want to do something. It's like, no, it really is a thing. It's really important to have that that mission, that
Yeah,
you know,
I mean,
what do you want to do?
even when we go away on a cruise now, or on on a vacation of some kind, after 10 days or 2 weeks, you say, "Wait, I got to get back." I mean, you know, it
Yeah.
it boggles you don't even remember where you've just been last week. What was that hotel like? What was this? No, you got it confused with that one, and it just all runs together after a while. I like the stability of being in the same place and doing a similar thing, but with many different subjects. Every investor is different, and there are so many different ways to go about it, and so many different products you can use, or individual securities you can be in. And I feel there are like 6 basic rules. If you pay attention to those rules, you're not going to go too far astray in investing. But when you see some portfolios, or when you hear some people talk about, oh, I just heard about this security on such and such show, so I went out and bought it. I mean, God, you say, how can anybody do that? Do you run out and buy every new product that comes on the shelves at the store? No, you don't. You look at it, you read the label. These people don't even read the label. They just go buy the security and hope it goes up. And that's all they care about. It's got to go up in price. Up is good, down is bad. And that's really not true if you do your homework. Because the markets and interest rates are cyclical. It's just like the weather. I mean, you got 4 seasons in every year in most places. And the market's going up and down all different times, every year. Yeah, I don't even use the calendar year as a measuring stick. I don't. I just say there's a market cycle, and right now we're getting towards the top of a cycle in the equity markets, but we're still not far from the bottom in the interest rate sensitive sector. So you've got different things going on in different areas all the time, and you just have to be aware of it so that you can come up with a plan. How am I going to deal with the next crash in the market? How am I going to prepare?
Yes, rather than will there be a crash, it's like how to deal with the next one. Brilliant.
There's never been a rally that hasn't succumbed to a correction, and vice versa. Every correction always, a rally always comes out of it. And particularly with the world is so small now, like even your markets in Europe and are impacted by what happens in the United States, what happens in China, what happens in Russia. The markets are affected by so many different things that predictability is impossible. But preparation is not impossible. If you look at these cycles.
Tell me a bit before we get into like all of those things in more detail, because I've got so many questions for you. Give me a bit. Let's go just back to like, what's your background? How did you get into this? Where did your passion for this come from? Like, what's your life story? And like we have a lot of time, so
life story
don't rush through it. But
in 5 or 10 minutes. Life story.
What's your life story in 5 or 10 minutes? What's the highlights? Like, where were you born? Where were you brought up? What's your family situation?
It's interesting actually. I was born in Manhattan in May of 1945. My wife was born in Manhattan 11 days earlier in Manhattan.
Wow.
Yeah.
Where did you meet?
I sat down next to her in 7th grade.
Wow. Yeah. I mean, we could do a whole podcast just on that, on staying married for that long, right? I'm assuming you're still married. And
we didn't get married. We didn't get married when we were 12. No.
Yeah. No, but you've been together the whole time, right?
We've been friends that whole time. We got married when we were 25. So we've been married a long time, 53 years.
Yeah.
So
wow.
Yeah. And we've never had a fight. Just kidding. Just kidding.
It's like, now we're definitely doing a podcast just on that.
But the start of my career in finance.
So did you grow up in Manhattan?
No, well, I actually I was born in Manhattan, but I lived in the Bronx um, as a child, and I don't even remember life there at all. We moved out to North Jersey, a place called Lake Apacon in New Jersey, when I was just 5, and that's when my father started developing land out there. And he had I don't even know how many acres it was, but it was, I guess the development probably today has over 1,000 homes in it. It's right on the southern tip of this lake. It's the largest natural lake in Jersey. And, and he built a beach and a clubhouse and all the tennis courts, basketball, baseball field, and all this stuff. And started building summer cottages for people who would come out from Manhattan. And then he'd finance them, and he'd have a lot of rental units, and he'd hold the mortgages. He had an office in New York City, and he had some properties in there also. And he had one of the people who worked for him ran the insurance end of it. And in New Jersey, he and his lawyer built a lumber yard. So are you familiar with the term vertical integration, where you have a business?
Yes. Yeah. And you've got all of the supply chain and everything. You own brilliant. Yeah.
Exactly.
Yeah.
So he really had developed.
Very smart.
The only thing he didn't do was borrow money. He didn't borrow money from banks. So he did everything from his own cash flow, his own income. And he started lecturing me on that when I started my first business. And I needed to have a business because I wanted to have a boat on the lake, and I wanted to teach young ladies, young girls how to ski so that I could meet people. And you know what a young guy is like. So, so I started a lawn mowing business. I'd go on knock on doors, and I'd say, "Do you want me to take care of your yard for you? I'll mow the lawn. I'll do some other stuff for you. Give me a chore, I'll do it." And I did that, and eventually I wound up having 2 of my friends working with me. So we had a little landscaping business. We didn't have any trucks. We walked around with these lawnmowers. We wheeled them around, but still, we got the job done, and we made some money. And my father said, "You got to start putting some of this money away, because eventually you want that money to work as hard or harder than you are. You want your money to make more money than your employment makes." That's what I do. I make more money, than I get, so forth. Anyway, so he put it away for me. And by the time I got to college age, I had changed my direction a little bit. I was not a great athlete, but I was an athlete, and I wanted to continue that. And I wanted to go to a small school that specialized in wrestling. So I went off to Gettysburg, Pennsylvania. That's a famous name, right? And even in the UK, people have known about the Battle of Gettysburg. Well, so went there, and when I got back and I started working, I found out that he had taken all that money that I had given him from in my teen years, and his attorney, like I said, had invested it. And when I got to be 25, they turned over a portfolio to me that was, and this is in 1970, $80,000 is a lot of money.
Wow.
In 1970.
That's a lot of money now for someone coming back from college to be handed over, right?
Yeah.
Back then
Well, I just got married, and
brilliant.
And I said, okay, what's my objective with this? My first objective was not to lose any of it, And I looked at it, and I studied it, and I saw a few basic things. I knew the name of every company that I had. And these days you had stock certificates. You've never seen a stock certificate.
No.
In the old days, you used to have little pieces of paper that told you that.
Actually, do you know I have? My grandma had them because she was into the stock. She passed away last year at 99. So she had them from her dad started giving her stocks when she was really young. So yes, I have seen them, but they they don't exist now, right? They're not a thing anymore.
It's all electronic now. But I had all these neat, and I can almost remember the color of the paper, the certificates. But I had things like Royal Dutch and General Motors and not McDonald's, but GE, Sears, Roebuck. So I must have had 30 different companies, and I knew the names of every one of them. They were all well-known companies and they had all different types of businesses represented. They were, and most of them were global in stretch. They all paid dividends, every one of them. Not one of them was a high flying. Of course, we didn't have IBM was tech in those days. Big. So there was IBM, but there was no real tech sector. IBM was a New York Stock Exchange stock. It was before the NASDAQ. Our NASDAQ stock exchange became a tech exchange. So I had all these great companies. So I watched them, and I look at charts, and I didn't make my own charts, but wherever I could find something like a chart, and it would show me how they fluctuated in prices, but how the dividends pretty much remained the same or went up. And they showed me how the whole world situation or economic situation definitely affected which way these prices went. And it was a lot like the tides, where all this qualityness, all this high quality, they'd all rise or fall the same way, except maybe the oil sector actually was the most volatile sector in those days, when the price of oil would dictate where dozens of companies would go, and the charts of the oil company stocks would be much more volatile than the ones of the retail sector, for example. So I looked at all this stuff, and I didn't do anything else with it except watch it. And I had given all the certificates to a securities broker who happened to be a woman, which was so rare in the 70s.
Rare back then,
There were never, but that didn't, and she almost adopted me, because I'd say, hey, what about this? She said, no, you don't want to just jump into things because somebody talked about it. You read it in the paper or stuff. You really want to study an investment and look at things. And then I said, what do you feel about, why don't most people take their profits? And we talked about that. I said, I'm going to start taking my profits on these things, because in studying these charts, I've seen they go up and they go back down again. They go up, they go up a little further, and they go back down, and they go up a little further. I said, what if we sold them up here and bought them back down here? We could do that, and we'd make a lot of money. And she agreed. And then I said, well, as the portfolio grew, I said, we don't have enough positions. We got too much invested in IBM. We got too much invested in Royal Dutch. And by the way, the first profit I ever made was Royal Dutch Petroleum. I don't know if it was called Shell Oil then, or Royal Dutch, or what it was called, but whatever the original company was, that was my first profit. And with my first profit, she suggested to me that I start thinking about generating more income than I was, and perhaps tax-exempt income, because I was paying taxes. And she suggested I buy a municipal bond. So my first footprint into income investing per se was Fort Pierce, Florida, 4% coupon municipal bond. And you've never seen a coupon bond, I bet.
No.
I'm going to show you a coupon bond. It's not Fort Pierce, Florida, but it's the South Mountain Railroad Company.
Amazing. That's totally cool. Go for it. So exciting, ladies and gentlemen. What a guest. This is history right here on the screen. If you're listening, it's worth getting the video up. Wow.
Pay the holder $100.
This is amazing.
This is $100 bond.
That's amazing.
This is way back in the 1800s. Okay. And then look below, and you'll see the coupons that people like my dad used to clip and take into the bank to get the interest. See down there?
Yeah. Wow. That is amazing. How things used to be done.
So there you go. Something your audience has never
it's so
seen
much
before.
when it's like when you can touch it, it's just a different game, isn't it?
But yeah, I have that on my wall. A lot of people find it interesting. When I used to have clients come into the office regularly, they'd see that. What is that? I never seen one of those.
Yeah.
So
Yeah.
But my father used to like those coupon bonds because it was his way of avoiding taxes, even in the corporate market. Because in those days, these were totally negotiable. They weren't registered anywhere.
Yeah.
So they were just like cash. I mean,
Wow.
if you grabbed that off my wall, it was yours. There was no my name wasn't on that at all, or whoever name was not on that. So so that's my first income investment was a coupon bond from the state of Florida, and I held it until it matured 30 years later. Now, I don't know if I did it for nostalgia purposes or what, but I held on to it. I didn't care. So anyway, this got me started on income investing. And of course, everything I owned was dividend. Everything was quality. So you've already heard about 3 of the basic principles of investing. Quality, all those companies, high quality companies, they all paid dividends. That's number 2 is actually diversification, but it was a diverse group. And 3, everything paid income. So those are 3, and these 3, what I call them pillars, and I call them pillars of risk minimization. If you stick with quality, you diversify, you generate income, you have lower risk than if you don't do those 3 things, or you don't do one of those. You got to do them all.
Yeah.
Really. You can't say, I'm never selling my Apple stock because it's gone up 3,000%. So what if it only pays me 1%? I've got $1 million that I'm earning 1%, but I love it. So I said, okay, I'll take that $1 million. I'll get rid of the Apple, and I'll start investing in a diversified portfolio, closed-end funds, and I'll be generating 10%. So he's getting $1,000. I'm getting $100,000. Who's better off?
Yeah.
You can't spend market value. You only can spend income. And the other thing about income and about money, you can only spend it once. You can reinvest it thousands of times. So so these are just basic things. So when I started,
well, the basic to you, and I love, before we came on live, you said it's very similar to property, which really got me because I'm property through and through, right? So I love property. So for me to go outside of property, I'm like, oh, I don't know, which is why I'm loving having this conversation. But everything you've just said is exactly the same for how I do property. It's exactly what I say to my clients. And yet you and I think it's basic, but for a lot of people,
it's not.
It's just not. And they ignore it at their peril, or it's almost so basic. It's a bit like you need to drink water and breathe air to live. It's like, it's so basic. People ignore it because it kind of just happens. And it's that. And I think when people are investing, I don't know what happens. They lose all common sense. And once you've got, I love the way you talk about it, that it's like, these are the rules, these are the pillars, these are the principles. You need to stick to these, because people get excited about, the latest hot thing. And it's the same in property. And they go, oh, this area in, it happened to me when I was first started out in Cardiff Bay, which is on the coast. They started building all these apartment blocks. And I was buying small 3-bedroom terraced houses up in the old coal mining areas. And I was going, no, you need to buy off plan in the Bay. And I went, no, I don't think I do. I think I'm going to stick with these. They work. They're not particularly sexy. The yield is good. And the people that said, go and buy here, the latest hot thing, they lost hundreds of thousands. They were in negative equity for, decades. Some of them might not even ever got out. And it's so basic and yet so ignored. I can't underline it enough to people listening. What you're saying, yes, it's basic. It's also everything. Because without it, it's like building a house on sand. Like there's no foundation, and then it all falls down. You know,
right?
It's just huge, and for people to get that, it then also makes things simple, because when you put something against what you've just said, it's usually no thank you to most things that are offered, right? It makes a lot of things.
Well, take Bitcoin.
Oh,
there are probably people that have made millions, but there are probably some people that have made millions and millions who have lost money. So, it doesn't meet any of those requirements. None. The income, the quality, the diversification, none of them. Anyway, back to the origin story. So I had this sum of money and I had this great person to work with, and we developed a portfolio, and we were generating good money. We had bits and pieces, mostly municipal bonds, and then I was working in New York at an insurance company at the time, and while I was there, I wound up in their pension investment department. And at that time, people had pensions, and they had pensions, and the only pension we have today in America is Social Security. And in a way, because it operates like a pension did. But the pension, and I can tell you, I have a theory about what happened, why pensions went the way of the wind and they were replaced by 401ks, but not many people want to listen to it. But I could have fixed that.
Wow.
But I think,
for people in, there's two questions I've got just on it's from a language point of view. So what would be a municipal bond in the UK? Like what's the equivalent?
City of London paper.
Okay.
City of London wants to redo the streets, they borrow money.
And got it.
In America, a municipal bond is federally tax free.
Okay.
Yeah. And if it's in the state, let's say buy New Jersey bonds, it's federally tax free and New Jersey state tax free.
Yeah. Because they want you to put the money in so that they can do what they want to do. So they give you that benefit to make it more interesting. Yeah. Brilliant.
Okay. So anyway, I got this portfolio. I'm working in the pension department. I got this job in the pension department, which allowed me to travel around the country with their portfolio managers. We had a defined contribution plan, which is like a 401k, where they matching funds and stuff like that. And I'd fly around, and we were talking to the people who ran these plans in all these various companies. I actually had a beer out of the tap of the kegs at the Coors Brewing Company, because they were one of our clients.
Amazing.
And Boeing was one of our clients. I mean, this company was a big name company. So I talked to the managers on the plane rides every time. I say, okay, talking about Boeing. And this is a story that I wrote about in my first book, which is called The Brainwashing of the American Investor. It's not, you can get it for free at my website. Okay. So don't run out and buy that book, please.
Bless you. Free. We'll make sure that links in all the blurb when this shows up recorded as well.
They'll find it. So it'll be there. Anyway, so we were talking. I said, I'm looking at the investments in our defined contribution plan, and you've got millions and millions of dollars invested in Boeing stock, which is where we were going. So I said, it doesn't pay much of a dividend. You've got at least $1 million in profit sitting there. Why don't you take your profit? Because I took profits in my securities. Why don't you take the profit, spread it around amongst other securities, buy some new positions, put it into some income producers? Why do you stay? So, Steve, you got to learn something about big company investment practices. We have an insurance division. We have an investment division. We have this division and that division. Boeing is perhaps our single biggest insurance client. And one of the reasons they remain with us is because they want us, or like us, to have large numbers of their shares in our investment portfolios. So the light bulb lit up the entire cabin of that plane what are you talking about? That's not economics. That's not that's not the markets. That's politics. That's in my pocket greed. I get your money, you get mine. So from that moment, that flash went off, I never ever held on to anything if I had a 10% profit. And that was my stock market parameter. So at that point, the fourth leg of the stool, that risk minimization pillars, the fourth leg was profit taking. Take your profits. Because if Boeing gets ticked off at ABC company and takes its money, takes the insurance business away, Equitable is going to sell 1 million shares of Boeing. And that price, at least temporarily. Right. So, and so you say, wait a minute. And this company is not the only one that's a pension investment manager or a portfolio investment manager. There are dozens and dozens of companies operating exactly that way. You scratch my back, I'll scratch yours. Fine. Let me take advantage of that. I'll take advantage of that because now I know those prices don't go up just because they're such great companies or for their profitability or anything else. Now I know something that most people don't know. So when I get 10% in my pocket, I take it, I find something else to invest in. And I probably will buy the same stock back again a dozen times over a period of time. Because I'll do the same thing over and over, depending on the cycle. When the cycle goes down, I'll start looking at those ones that go back up. I'll buy them again. So that was that's how that fourth pillar developed. Profit taking is now, I sometimes some years I make as much money on profit taking as I do in the regular base income that the securities produce. So there are two streams when you're thinking of your income. If you get to the point where you're starting to think about your income or you need to think about your income from securities, there are two streams of income. First stream is called base income. That's the income that comes from dividends and interest from the securities. And the second stream, which can be just as big in the right market environment, like 2021. 2021, my firm made for our clients $7 million in base income and $7 million in capital gains. That was the best year ever in my experience. So, that can happen. There are people in my Facebook groups who talk about adding months of income to their through the capital gains. Like, we made the equivalent of 3 months of income this year, or 4 months, 1 year, and I made a whole year's worth of income by selling. So it's there. It's there for the grabbing.
And the capital gain within a share price is because the share's gone up in value, right? So you've got your payout of your dividend, and then you've got the actual share value's gone up. So are you then saying that you're selling that stock because of that, or you're just acknowledging that it's now up there? Or are you, when it hits a certain amount, you're going, right, we're going to sell and move on?
The fact that it's up there doesn't mean a thing, because as you know, look what happened. Look what happened
unless you sell, you don't
in March of
it.
2020. I mean, that was the largest drop in a 2 month. It was a 2 month correction. It went down all the way, and then it went right back up. And I was so angry about that. So angry about it going back up so quickly. Because my portfolios are generating all this income, and I wanted to be able to reinvest it at those low prices.
Keep buying at that low price.
Right. So I didn't get my wish in 2020, but I got my wish in 22. Because right now, the U.S. stock market measured by the Standard & Poor's 500 is lower than it was on January 3rd, 2022. 2 years. It has not established a new all-time high. Only the Dow has been at a new high, and not by a whole lot, since that time, back in 22.
Wow.
Or late in 20. The NASDAQ was November of 21. So that's been 2 years and 2 months since it's been at an all-time high. It's still 1,000 points away from an all-time high. So it's not getting there anytime soon. So within all that's going on, the focus on incomes, the thing about income, the thing about your rental properties,
Mm.
those 27, 30 rental properties you have, is that what you said? Or
Yeah,
was it more? It was more than.
I've got 15 now. Owen's got, I think, 35 units. So
All right,
yeah,
so you got
yeah,
let's
between
say you got
us,
100.
yeah,
You've got
yeah.
100. You've got 100 rental properties, and they're all occupied, and they're all paying their rent on time. You hope, and I hope your laws are easier to get rid of somebody who doesn't pay than they are in our country.
Yes and no.
Maybe not
Yeah,
yes and no,
yeah, yes
but
and no. Swings and
but the thing,
roundabouts. It's
but
part of the
they're all
business, isn't it?
paying, but they're all paying that
They're
income every
paying.
month, and
Yeah.
that's what I do. That's what I do with these securities that I use, and we'll talk about, I'm sure, the securities I use. But the securities I use are managed portfolios of all those wonderful stocks you read about, the Apples and the Amazons and the oil companies and the car companies, the Tesla, all those things are in these equity closed-end funds that I use. But I don't buy any of them that don't have at least 50 different companies inside, because that's the diversification I want.
I was going to say that's your rule, right? Diversification.
That's my
so
rules.
You've got to keep following it. Yeah.
Most of the things I use are guidelines when I operate my systems, but rules are rules. I mean, if a company doesn't pay a dividend, I don't care how popular it is. I'm not going near it, because it's a matter of respect. If I own shares in a company, I'm an owner. I don't get paid like the CEO does, but I own it. And if they're not paying a dividend, then they don't care anything about the owners. That's in my opinion. I've got to get something for my investment in that company, and it's got to be in the form of cash. I can't spend market value. On the top of that book over there, if you read the tagline on it, it says, "Market value fuels the ego.
Yeah.
Income fuels the yacht." In other words,
brilliant. I love that.
You can't spend it, so go get it. When it's like, you're walking down the street and there's $100 bill sitting there, you didn't see it drop out of a guy's pocket, so you're not being a bad person by picking it up and putting it in yours, and or you're gonna let it sit there and hope there's 200 there tomorrow. That's the same difference. That's the same as the stock market. You got that 10%, 5% profit staring you in the face right now. It may not be there tomorrow. So you take it. So by the end of by 2000, I got this money in 1970, and I worked with this lady, and I worked with her for almost 9 years until she retired, and then her replacement part was really not. He was more of a typical broker. He wanted to try to sell me stuff and things like that. So I felt that I knew more about this stuff than he did. But in any event, I was working, like I said, I was working in Manhattan for this life insurance company, and I was making what in those days was, I guess, a reasonable amount of money, but I really wasn't getting ahead or anything like that. But my income portfolio, which it was 70% stocks at that time. My portfolio was generating 4 or 5 times the income with the profit taking that my job was generating, 4 or 5 times. So I talked to my dentist, and I talked to this guy that my wife and I become friends with. We met him on our honeymoon cruise, and we were still friends. And he had a restaurant out on Long Island. And I said, "Hey, look, guys, look at this. Look at my portfolio, and look what I've done with it in the past, 9 years. I'm going to go I think I want to go in business doing this, and I'm researching how to go about doing that. But if I pull the trigger and leave this job and do that, will you guys be my first clients?" And they both said they would. So with maybe 20 grand each as an initial portfolio, I quit and started this business, and told my bride that we're now living off my income from investing. So, maybe don't buy 2 dresses the next time you go.
Just take it easy for a bit.
Take it easy for a while. Let's see how this plays out.
Yeah. Wow.
So that's how I got there. That's how I started investing money for other people. And
Amazing.
then you had to take tests, you had to pretty much go back to school and take courses, and you had to learn about all of the securities and all the markets, even though you knew you weren't going to touch most of them. But and then you had to pass these tests, and you had to get registered with the Securities and Exchange Commission. I was an RIA, a registered investment advisor, and I had my own registered investment advisory firm. I formed a corporation and did that. And I was looking for a broker, and the bartender at our favorite restaurant on Lake Apacon was a part-time bartender, and the rest of the time he was a stockbroker.
No way.
And I told him about my dilemma, and we'd become friends over the years, because every night when we got there, before we drank, we had a drink before we went to dinner and everything, and everybody at that place knew each other. Lake Apacon was a much smaller community than it is now.
Yeah.
And he said, why don't you, if you're not happy with your current broker, why don't you come work with me? Sounds like a plan. So I started working with him for my personal accounts. The other my two clients, they also went with him, but I had developed a couple other relations with clients had wanted to use their current brokers. So for a few years, I was working through several brokers. And then finally, Ken was the only one that it seemed to click. He got when I said sell, he got as excited as I did that we were taking that profit. He didn't say, oh no, our people say it's going to go up some more. I said, because I don't want to hear that. I'm going to take that. And he adopted my methodology. He even eventually started letting me manage his IRA and everything, because he bought it. He says, it's unfortunate that nobody will sell this, and I can't sell it to our bosses and stuff like that, because it just flies in the face of everything they're trying to do. They're trying to corner your money into mutual funds, and today particularly model portfolios and stuff like that, so that they can get the most under management with the least effort, the least number of employees. I mean, you could call up investment advisors all over the place and find some that would invest your money different from everybody else's based on your requirements. And there's just not that many out there anymore. Everybody's buying these models. Even with closed-end funds, there are model portfolios you can buy. And there are a lot of things they do in model portfolios that I just don't approve of. I want to invest every penny of my income selectively. I don't want to automatically reinvest stuff. All that does is it ruins diversification, for one thing. You wind up buying, the market goes up more, even though we've had a 2-year not so great, the market goes up really more often than it goes down over this course of time.
Yeah, over time, yeah, absolutely.
So if you have this automatic reinvestment going on, or the dollar cost averaging thing, you're oftentimes increasing your cost basis of your position, because you're buying at a higher price than your average, and you're reducing the yield. So I have a broad enough portfolio that there's always something that's down, because I've taken my profits and I've reinvested, and I can always buy at a lower price than my average, so I can increase my yield and reduce my cost basis. And a reduced cost basis means you get to a profit position sooner. So it's a counterintuitive process compared to what Wall Street wants you to do it. But it works. It works so much better at building income.
Well, I think it's the difference, isn't it? It's the difference between thinking about it and actually going, well, what works, rather than, oh, this is what everyone's doing, so this is what we'll do, without questioning it. It's a bit like everyone was buying apartments down Cardiff Bay. So I was the weird one going, no, I'm going to stick up here, thanks. And it takes something to be the one that goes, no, I'm not going to go with what everyone else does. I'm going to do this because it makes sense.
Right.
Sometimes things that make sense aren't what everyone's doing.
Yeah, exactly. So this approach is much more like running a real estate portfolio than it is like the normal advisor would run a stock market portfolio. And it just works so well. You're not in the EU anymore, so they're still closed-end funds. Let's not get into that one. I don't know which side of that coin.
Well, I could go either way. I think it's all just a mess. So it's
it's a mess. Hey, I think we've got you beat when it comes to a mess.
Well, so. I'm not going to argue with that. I think that
you're. It doesn't matter.
I think you're just a few years ahead of us. I don't think it's that you're like more of a mess. I think you just kind of got to the mess that we're getting to a bit faster. I don't think we can take any glee in the fact that you're already more of a mess.
Okay. All right. And that's it for the politics for this round. So, so where were we?
So
question.
So one thing that has always put me off stock market and shares, and I have a very good friend who is he's a financial advisor, and we've always had these fun conversations because I've always done property and he's always done stocks and shares, and he's done property as well, but he always flipped property. He'd never buy and hold, so he'd never do it for income. He'd do it for the capital gain, and I'd be like, it's not worth all of that work to take such what I would call a small profit now when you can have, a capital gain plus the income, the whole deal for a long time. Whenever I did the figures on any property I did, because I did a lot of very heavy refurbs, I could just never sell at that point. It'd be like, this is such a small profit compared to what I'm going to make over time. And we'd have these conversations about, the kind of two different things. And then he did all of his qualifications and, does some quite serious financial advising now. And I would still be like, no, I can leverage property. I know where it is. I can go and see it. I'm not, wondering whether the CEO of whatever company is, doing something disastrous that's going to lose me all my money, all of that stuff. And so then I've done lots of reading about, even like Anthony Robbins, and there's a few people who've done, books about, look, just put things into, a stock market, spread bet it, leave it. And then there's a dance between bonds and shares and all of that. And then it's kind of completely hands off. And I kind of go, I don't want to be completely hands off. I still feel like I'm following a program, which is, I think, what you're talking about, right? When people just say, well, just do this and forget about it. So your approach, I think what's coming up for me is like, how much time does that take? How do you know? Like, because you've been in this world from the beginning, right? You understand it. You've been on airplanes with fascinating people.
You mean the financial world, not the world.
Yeah. Right. The financial world. It's like the financial world and all around it. So you have this level of understanding that, your average person just goes, I don't really know. And what do you say to people who are not in the industry, who are going, geez, what do I do with my money? Where do I put it? I know I need to make money on my money. I know that just being in a job and having income, it's not really sustainable. Pension returns, just putting it in a company pension is really not great. And I love that you explained why that is today. That's kind of made a lot of sense to me. I was like, why are these massive corporates who seem to say like they know what they're doing make such relatively crappy returns? It's like, because they're doing stuff for each other, not for their clients. So it's like, what do you say to, an average person earning, an average wage? Where do they go? Where do they start? How do they, because I would say most people probably that listen to podcasts are in that realm. Most people aren't in financial services. Most people have got, they're working a job, they've got kids. My answer to it was, I'm going to buy houses because I can control it, right? It was like, bang, I'm in and I did it and it's fine. What do you say to people who are
well, there's a lot of
getting it conceptually, but wondering,
a lot of questions there.
Yeah.
So let's see if you can keep me on track here. Okay. It's true that I feel, and I feel because I was fortunate enough to be able to do it, that the sooner you can get yourself into some form of investing, the better. I had a coaching meeting with a couple just Saturday. Yeah, Saturday, and these people were in their 40s. Okay, now that's not they had a lot of money in a 401k and a lot of money in a 403b. 403b is for same as a 401k, but for teachers basically in the U.S.
Okay. Yeah.
And very little in a personal account that they could do what I do. So this woman and her husband are taking $300 out of her. She's very impressive. She's a physician's assistant in a transplant unit or transplant hospital in near LA. Very impressive young woman.
Yeah.
And the two of them are taking $300 and $500 from their salaries every paycheck, and they're starting to buy these closed-end funds that I use. $300 or $400 at a time, but they're doing the process. They're doing the quality checking. They're getting all they got the information from me of the universes they can select from. And they're buying a little bit at a time, and they're diversifying, and they're taking their profits as they go along. And they make, I made $350 last week, and that's a big thing because $350 is amount one of them is taken out of their check, so they've gotten an extra paycheck's worth of money into their investment account. So people should start early. One of the benefits of using the closed-end fund approach is you can buy a portfolio of all the best stocks in the world, and you can get it for $7 a share instead of $700 a share. So you got a little piece of all those companies in a diversified portfolio, so that your risk of loss is much, much lower because it's diversified. And that's the way she's starting. So the other side of that same coin is that money that's sitting there in the 401k and the 403b that they can't do anything about. They have a choice of various mutual funds that they can put it in. Most people, and I've had clients who've come to me with a portfolio full of mutual funds, and they didn't even know they were in the stock market. So I've never owned a stock. I said, yeah, you own a stock. Your whole portfolio is stocks.
Yeah, I was going to say, what did they think they were owning then?
What you don't own is any bonds. You don't own any income producers. So your $400,000 in your 401k is yielding 1.2%, and now you've rolled it into the IRA, and you're still yielding 1.2%, and you're going to try to retire on it. Well, the only way your advisor can make you retire is if he sells something every month and gives you the money. Well, that's burning up your capital. That's like taking one of the rooms in a condo and say, all right, we can't rent that one anymore. That's not in there anymore. So the problem is there's no educational system that tells people about this type of thing, and they all keep their money in the 401ks and the products like that. So when do you start? You have to know that there's a better way out there, and how many people are we going to reach today that are going to know that there's a better out there? That's the thing. I mean, the financial community is not going to tell them about closed-end funds. You can go to your banker and ask him if he's ever heard of closed-end fund. It's likely he hasn't.
Just explain to me and to people listening what that is, why it's different.
Okay. What is a closed-end fund? Why is it not? It's not the same as an ETF, which are popular all over the world now. It's not the same as a mutual fund. It's actually been around longer than either of those. Closed-end funds were first developed in the 1800s, about 30 years before mutual funds actually came into being. The difference is when you buy a mutual fund, you're actually buying units of a fund that owns those securities inside the fund. So you effectively own them in form of units. So if the world panics and everybody wants to sell, the mutual fund has to sell things to give you your money back. Okay. If the market's going up like crazy and people throwing money at it, they can buy more and more and more shares, and it looks good and you're growing stuff. They don't generally pay more than, the average is less than 3% in dividends that they pay, although some of them do pay significant dividends. An ETF is similar. It owns a lot of different securities. The one other thing about a mutual fund, they have what they call a net asset value. And overnight, you can't buy or sell one during the day. You can only do it as the market opens the next day. So every night they make the price of the value of the securities inside. They make that times the number of securities out there equal to the net asset value of the securities. In other words, the number of shares are manipulated every day. The same thing with ETFs, although they do trade during the day. Overnight, somehow they make the number of shares equal to the number of shares, price of the shares equal the net asset value. In closed-end funds, it's a totally different ballgame. Closed-end funds are not mutual funds. Although even in Wikipedia, if you look at the definition, it'll tell you that these are closed-end mutual funds. They're not mutual funds. So they're trust vehicles. And I'm sure you've dealt with people who have trust vehicles in the real estate business, right? And these are pass-through trusts where the company that manages the trust, and we're talking about companies like Nuveen and PIMCO and BlackRock, biggest investment companies out there, right? They form these individual trusts that they put a name on, and they do an IPO, and they sell the shares to the general public, and then they take the money they received on the IPO and they buy a portfolio of securities, like a portfolio of stocks, maybe 200 or 300 different companies, and that's their portfolio. And that's the first step. But the idea that they're a trust means they're a pass-through trust. Any income that's produced by these things, be it dividends or interest if they buy bonds, or capital gains if they do that, or option premiums if they sell covered calls, all of that money that they get as income, less their expenses, 95% of that has to be dispersed to their shareholders. 95%.
Wow.
Now let's say, how big do you think Amazon would be today if they had to pay out 95% of their earnings to their shareholders?
They wouldn't exist in the size that they do. We might not even know who they are, right? That's.
So consequently, you can't look at closed-end funds like you can at individual securities, mutual funds, and ETFs based on how high their price goes. Because there's no way when you're paying out 95% of your earnings, can you grow? You can't grow your base because you're giving it all. It's all going back out. So they're different in that respect. The price actually does not track with the net asset value of securities. Okay. The price can be higher or it can be lower. You can actually buy all these securities at a discount if you buy it below the net asset value. But why does the net asset value change? It changes because of what the market is paying for securities like that bond we are looking at. If interest rates are higher than they were when the bond was issued, the price of that bond is down, because the guy who buys it from you needs to get current interest rates. If if interest rates have gone down, then the price of that bond goes up, and you can actually sell it at a premium. And these managers will do that, and that's how you get these profits. But in the meantime, the net asset value right now, after interest rates have gone up 5% in the space of 2 years, actually it did about 18 months, but it's now 2 years since the last upward movement, all of those bonds are lower. All the ones that had been owned have to be lower in price. There's nothing you can do about it. It's not a function of quality. These could be treasuries, for God's sakes. They still have to go down in price. So people get all upset that the net asset value has gone down. They don't understand bonds. They don't understand treasury bills. But that's what you're dealing with closed-end fund. So you have to focus differently. You can't focus on that market value. You can't focus on net asset value. You got to focus on the income that this sucker is producing for you.
Same with housing, right? I don't care if my portfolio dropped 50% today. It doesn't matter. The rent's the same. The mortgage is like, it doesn't matter. Unless I'm selling, it's not a problem.
Right.
People,
And
like you say,
it's the
people don't get it.
same thing with a portfolio
Yeah.
of income producing securities, particularly
Okay.
in closed end funds. I mean,
Mm.
think about it. You know what laddered maturities are? When
No.
somebody develops a bond fund,
Mm-hmm.
and they're going to only purchase fixed income paper, fixed income
Okay.
bonds, fixed income
Mm-hmm.
notes, mortgages. All of these types of securities have a maturity date. Like it's a
Yeah.
30-year note or a 15-year bond or a
Yeah.
90-day treasury bill. They all have a maturity date. So eventually you're going to get the face value of that bond. So if it's at a premium, if you're a manager, you say, I better take that profit because it's going to mature at the face value, not at the premium. If it's
Yeah.
down, you're going to say, I don't care if it's down. I can buy more of it at a higher yield, right? Because it's down, and I'm going to get the face value when it matures. So here we have these, and everybody you're taught in bond school that when you set up your bond portfolio, you ladder your maturities. So you always have some of them maturing that you can reinvest at current rates because you recognize that interest rates are just like the stock market. They go up and they go down. They go up and they go down. So if you're a smart bond manager, when interest rates were falling for 12 years from '08 through 2020 or beyond, you weren't putting big chunks of money into long-term bonds, were you? At 1.2%? No.
Yeah.
You were buying a lot of short paper that would mature so
Yeah.
that when it matured, hopefully you'd have higher
You can. Yeah.
rates. And that's what's happening right now. So even though prices are down and everything and yields are still up, these managers have maturing paper that is maturing maybe a 2% yield and they're investing it at 6%. So the distributions on these things, particularly the ones that label themselves short term or floating rate, stuff like that, they're all raising the dividends. Last year, in my universe of income bonds, there are 87 separate dividend increases in that particular universe, just mostly from that type of paper. So that's what you're buying. You're buying a different type of animal. It's paying out all its money, so it's going to trade at a range. It's going to trade 10 points in either direction or 8 points in either direction, but it's going to be a narrow range. It's going to be a lot of fluctuations.
And what's in it for, so coming at it from every angle, what's in it for the people setting up the trust and doing that way, paying out all that income?
Oh, they pay the manager. The manager gets paid more money than the managers of the mutual funds that pay 0.5% or where the cost is 0.5%. The cost on these will be almost 2.5%, but you don't pay it. You get the distribution net after expenses. Because the profit, you're getting a piece of the profits or the income margin, and the net income is after expenses. But here's something. Here's the I'll call it the intelligence of the regulatory authorities in the United States. And it's not. It might even be FINRA. I'm not sure. It's not the SEC, but they've determined. Now these closed-end funds I've got 240 of them that I own, and the average yield on the income ones is over 10%. The average yield on the equity ones is over 9%. The average yield on the tax-exempt bonds is over 5% after expenses. In their wisdom, FINRA has dictated that the 401k and that type of investment cannot have any security in it that's paying more than 1% or 2% costs or expenses, something like that. So you're not going to find any this type of security in there. So what they're saying, in effect, is you could have this wonderful Vanguard fund, and I have nothing against Vanguard, but you can have this Vanguard fund that's only charging you 0.5%, but it's only yielding you 3%. And that, ladies and gentlemen, is better than having this closed-end fund over here that owns exactly the same types of securities that are inside that Vanguard bond, it's unfortunately it's paying its manager better. You're paying, and it's paying one other thing that we have to talk about. It's paying 2.5%, but it's paying you 10%. So the SEC says, nah, it's paying that guy too much. You can't have that bond. 10% is not as good as 3%. What are you kidding? So that's the mentality. That's the regulatory mentality that we deal with in the States. But let's talk about the other source of not the other stream of income, but the other way that the closed-end fund manager has to make his product generate more income than either mutual funds or ETFs or the securities that he owns. That is the word that you mentioned first in this discussion: leverage. And I guess we should explain what leverage is. Like in the real estate business, leverage is the money you borrow from a bank that you buy another property with, because you're going to generate more income from that property than you're going to pay in interest to the bank. That's leverage. Without leverage, in the United States anyway, most people would be driving to work on bicycles because they wouldn't be able to afford a car without leverage. They wouldn't be able to have a home without leverage. They sure as hell wouldn't be able to educate their children without leverage. So the financial world has made leverage a dirty word, and they say, "Oh no, you can't use these closed-end funds. They use leverage." But you say from now on, what you say to your advisor, well, you're trying to sell me Apple. Do they borrow money to run their operation? Well, yeah, of course they do. What about General Motors? Did they borrow money? I mean, what about the 40 Dow stocks? Do any of them use leverage in their operations? Well, yeah, of course they do. But a closed-end fund can't. It's a bad thing because it uses leverage. So what it does, it goes to the bank, and for the last so many years, it's been going there and say, "Hey, I want to borrow some money at 2% because I'm going to go out there and I'm going to put that I can put that in stocks where dividends are more than 2%, much less the potential for selling them profits. Or I'm going to buy bonds, or I'm going to buy mortgages, or I'm going to buy real estate." And there are closed-end funds that do what you do, real estate. So, and that's what they're doing. So it's a dirty word because people will buy these things and they will no longer go back and need common stocks anymore. They will no longer worry about how high their profits go or how high their market values go. They'll worry about the income that they're being generated. They'll be happy. They won't need you as much. So that's why they say about that leverage is such a bad thing in these things. Did you know that the EU outlawed closed-end funds?
I didn't.
And you have to have a special, I don't know if they call it a license or just a special designation as a professional investor in order to invest in them, which is unfortunate. Fortunately, my book works just as well with dividend stocks as it does with closed-end funds. It just doesn't generate quite as much money.
Sure. Yeah, because actually, once you've got base principles that work, right, you can apply them.
Yeah. Well, I did, right? Because that's how I started my whole gig back in '79 with these basic principles, and I didn't start using closed-end funds exclusively until 20 years ago. So that sounds like a long time, doesn't it? It is.
Well, I don't know. Yeah, it's time's funny, isn't it? I'm 43 now, so I was listening to, I can't remember what I was listening to the other day, but they were talking about, I'm 43, so when I was born in 1980, the gap between now and then the gap between 1980 and then 1940 and 1937, it's the same, but it doesn't feels like such a big gap compared to this end of that 80 span, right?
There weren't
You've
television.
had the privilege to actually see, right? Like all of that. I don't know how that feels to you, but it's...
Well, I didn't have a television when I was born. There were no televisions. There were no color TVs until I think I was in high school. Yeah, it was big difference. I mean, you should have seen the original phones that people had in their cars, the portable phones they had in their cars. I mean, it was a box with a mass of electrical stuff and a phone that you got to pick up, But now people can talk in earbuds.
Well, yeah,
Have,
so I've got on, right? It's just another
I haven't
world.
gotten to the earbud stage yet. I've got a problem. I have a cauliflower ear from wrestling as a kid.
So you can't put it in. Yeah.
Yeah, in the left ear, wouldn't be able to get the bud in. So we're concerned about. Fortunately, these new hearing aids, which eventually, when you're my age, you start thinking about. Yeah, eventually you're going to need these things. I hope I need them. I hope I need them. So technology is an amazing thing. I mean, automobiles. I mean, it's just phenomenal.
I mean, even when
we've experienced an awful lot.
Yeah, like even when I bought my first house when I was 20, there was no internet in the same way there is now. We use Rightmove in the UK, where all the agents are, all the houses are. You can do all your due diligence from a laptop. There was none of that. There was like knocking on agents' doors, saying, "Right, what have you got?" And then traipsing the streets looking for houses and all of that. And it's so different now. I almost can't imagine that I did it the way I did it. It's just amazing. What so if people want to start doing stuff, so tell me how you work. Tell me what you do and how because you've alluded to coaching and having clients and stuff. How do you do that, and who do you work with, and who is your people like? Is there a net worth? Is there do you pay for your time? Like, how does all that work?
Okay, so I started doing coaching about April, which was about a month before I sold the business in May. And it's there's several different things that I do. I can sit down with a person and look at their portfolio. Like if you were to give me your portfolio, I'd look at the account statement. I'd look at it and say, okay, I know it all. I understand all these securities. Portfolio is this size. It's got more than 5% in 1, 2, 3 securities. That's too much. Should do something about that. It's got, oh my God, it's got Apple and it's got a 3,000% profit in it, but it's 27% of the portfolio. So if the board of directors is flying along in a private jet and it runs into a mountain and the stock falls 60%, this guy's, so I look for I do a QDI plus PT, quality, diversification, income, and profit taking. I see if they're using those 4 pillars of risk minimization. So I analyze their portfolio and say, hey, you got some risky stuff here. You got an overall risk here. You're not well diversified. And most of the times I say, you've done a pretty good job here, but the income sucks. You got a huge portfolio, but it's paying you 2%. We can change that. And we're at the market's right. And today I'm telling people this is the perfect time to go. Let's say you're 60 and you've got to take this equity-based portfolio and get some income out. Well, the market's just gone up. It's almost as high as it was 2 years ago. That's a big thing. So now's the time to take those profits and move them into income producers. So it's a great time for that. It's a terrible time to be buying income securities because they're high. So we'll buy half of what we'd normally buy so that when the interest rates start to come down, we can take profits and, that type of thing.
I think one of the things I love about that is that I need to check this before I assume it, but what's the next step? Like, what else do you do? Because what I'm hearing there is you're advising without a vested interest, which I think clouds a lot of the financial services industry when they're getting, it's like they're selling certain things because that's what's going to make them money, not make clients money. I think that has to be said in these kinds of conversations. Like that's how the industry works, right? And rightly so, like everyone's got to get paid.
It's not only is it how it works, but over the years, it's been how they got their year-end bonuses, and who went to the trip in Miami was based on how much of this fund or that fund you sold. There's always been that type of incentive in the brokerage industry. Commissions have gone now, so that's better. But now they have this fee stuff. Yeah. So yeah, when as a coach, I'm not selling my management services anymore.
Yeah.
And only, like I say in the book, I say, if you want me to introduce you to somebody that already does it like I do, I can. My old firm still is doing it. Those same two guys I told you about are still there, 50 years later. So, but,
wow.
but I don't push that. And I will tell a person, no, I think, if you have the time, and you asked me about that, if you have the time and the skills, you certainly can do this yourself. But if you need somebody, you're going to have to tell him, you're going to have to give him a copy of Retirement Money Secrets and say, here, this is
how
you want me to continue to pay you your 1.5%. I want you to do two things. I want you to read this book. I want you to implement these procedures, and I want you to assure me, you never used the word guarantee, I want you to assure me that you will try to make at least your fee in profits in my account every year.
Yeah.
In 2021, we made the equivalent of 5 years fees for our clients through profits. So that's, but I just, for the second time, I missed it. You sort of asked me a question. I haven't answered it yet. But yeah.
What else? So there's a coaching part of it, and then you've got your old firm that does things.
Right.
And then
so there's,
are you doing
there's portfolio review, where I just tell you what's good or bad about your existing portfolio. Then there's portfolio coaching, where I do the same thing. I tell you what's good or bad about your portfolio, but then we draw up a plan to transition you to a higher income portfolio. And depending on how experienced you are and how confident you are, we'll have 1 or 2 or maybe 3 meetings, and then you're off on your own, and maybe you'll call me back in 5 months or so and say, hey, I want you to see if I think I'm done. Let's have a portfolio review meeting, and you can tell me that I've done a good job. And I have several clients who said, I want you to work with me until it's done. I want to meet with you every month. So I have a special retainer type fee that is about a third of doing it without the retainer. So that's the coaching and portfolio review. I'll sit down and just do a private Q&A with you. Make a list of questions about investing in general, CEFs, stock market, whatever you want to talk about. And you got me for an hour. So that's another thing I'll do. Then the final thing is these universes I spoke of. See, I have to put them together for myself, because this is what I do. I make up a new set of universes every month for me to use in my own portfolios. And I'm doing all this stuff all the time. So every month I have 3 brand new universes, new prices, new yields. I've tracked the distributions on them, who's made special distributions, who's gone down, who's gone up, so on. All that information is there, and I sell them to people, and they can get a whole year's worth of those, or they can buy them separately. They can buy the equity one, they can buy the income one, they can buy the tax-free one for a price, or they can get them for like $10 a piece if they buy them for a year in advance. Yeah, so that's what I sell.
And define universe. That's like, is that you picking all of the things that you're saying you're putting your money into?
Good question. Exactly. There are approximately 450, maybe 500 closed-end funds that are on the New York Stock Exchange, and the QDI, quality diversification income. I spell out the tests in the book. After I've done all those tests of all those entities, I have about 100 fixed or taxable income, about 100 equity, and 40 tax-free funds that I use myself. And that's what's in my universes are the ones that I am buying for myself right now.
And how often do you do that?
Every month.
Every month. Okay.
Every
Cool.
month. I just published them yesterday. This for January. They're all published. All but there are 4 securities that have not yet declared their dividends. And those are 4 ETFs that happen that I include in my equity universe because of their high yields. Actually, I include 8 ETFs. 4 of them invest only in closed-end funds. So that's like a no-brainer, right? The others are high income. One is BDCs are business development corporations.
Okay.
They're a similar product to REITs, but it's not just real estate investments. It's all kinds of investments. But I don't do individual REITs or master limited partnerships anymore. I just do them if I find them in a shell, because there are tax implications in the U.S. with these things, and they have to send out separate tax reporting forms, and it delays. Most people like to get their taxes done early, and sometimes these things don't come out until April, and then they have their accountant to refile garbage like that. So I don't do that to people.
And how does it work with things like you said earlier that the EU had banned the closed-end funds? I don't know where the UK sits in that, because we did the whole let's leave the EU, but loads of stuff stayed in place, but we chucked out loads of other stuff. We didn't put things in place for a load of other things. It's chaos, in a lot of, I mean, even simplistically, we used to have an au pair, and now we can't have an au pair because nobody put anything in place to have au pairs anymore for travel, right? Like that's how,
really,
just on a very micro level, like what we're dealing with in the UK, where it's not because anything was banned or said it's not allowed. It's just because nothing was put in place, because we left, but we didn't do anything. So how does it work when, obviously we're having this conversation US to UK, the stuff you're doing is in the UK. People mostly listen in the UK, but actually there's a few people, here, there, and ever. And there'll probably be more people in the US now. Hello to all of you, because they'll have seen your name and be following you, and then listen to more things from you. So how do people deal with the international, world of stocks and shares, and knowing what they can do and can't do?
Okay. Like I said before, the nature of the book is such that you can use it with any securities, the principles and so on. As far as I know, England, and I know Australia and Canada certainly have markets for closed-end funds. Canadians for sure, and I'm pretty sure you guys do. It's just the ban was just in the
EU.
In the EU, and that's just recent. And a lot of my it's funny. I mean, many of my. In fact, I'm doing a Q&A, or a brief piece of a Q&A in the Netherlands next week with the people who I've worked with on the book, and who have a closed-end funds group in a Facebook group there. So it's interesting. But yeah, you guys definitely. I'm almost definitely sure that you guys can do closed-end funds, if not all of them. Hopefully the ones that I have in my universes you could do, but if not,
there's nothing stopping us buying your universe in the US ones.
Right. I have Europeans who have my universes.
Yes. And
then
what do people need on a very? It's so interesting having this conversation, because when I talk to people about property, I'm like, yep, understand all that, got that. And I find myself going, I need to explain this to people because they might not know. And I'm listening to you going, okay, on a very basic level. This is like when people come to me going, how do I buy a house? I'm like, how do I buy a house? It's really easy. And it's not, right? Like, for people who've never bought a house, they're like, it's not easy. What do I start? Do I need to, or like, so if people are listening to this going, and I'm listening to this going, this is really interesting. This is the first time, you're the first person that I've spoken to. I've spoken to a lot of people, not on this podcast per se, but, over my lifetime, who have sort of tried to get me interested in shares and stocks. And I'm just like, no, it's not happening. And I can't remember whether we said this before we came live or since, but I think it was before we came live, all of my houses have boilers and roofs and leaks and maintenance and people and things that need dealing with. Like, I have to manage my own business. Whereas this, sure, there's stuff to manage, but it's a different ball game. And in the past, that's put me off, you know, and I've got a 5-year-old and a 3-year-old. So I've spent the last few years as well, you know, just being a mum and dealing with all of that new stuff. I'm coming out the other end going, I don't really want to buy any more houses. I'm kind of done with roofs and boilers. I have enough to deal with as it is. And my husband has even more than I do. So, you know, as together, plus we're in this house, which has enormous amounts of work that we're doing. So this is probably the first time in my life where I've actually seriously gone, what Steve is saying is like, what I would have said in the past is bringing me over to the dark side. That's how I would have worded it.
Right.
This world, like really, I'm like, nope, I know where my houses are. They exist. I can visit them. I'm in control. You know, the whole world of stocks and shares is like the dark side. It's all out of my control.
I get that. I was telling you, my father, who was the real estate guy, just like you, never borrowed money, and he never bought any stocks. Those coupon bonds were as far as he ever set foot. You know, he'd take mortgages and stuff like that, but no, but he would never buy a stock.
So like, what does someone like me go? So I go, okay, I think maybe it's not as dark as I thought it was, and I'm kind of a bit exhausted with real estate, and I'm thinking about going, all right, so like on a very basic human level. Like, I know if I want to buy a house, I go on Rightmove, I look for a house, I check out the figures, I do all of the things that you said. So I'm very familiar with like all of your pillars and stuff. I'm like, that probably is what got me. I was like, okay, he's not trying to sell me Bitcoin, because the numbers of people that, you know, do Bitcoin. I'm like, you are mental. I'm not coming anywhere near you. And everything you've said, I'm like, that's completely aligned with how I do real estate and property, and I get the income thing, and I get that I don't care what the price of the property is, and you said the same about shares. So I'm like, okay, there's enough common ground. If I go to buy a house, I go on Rightmove, I find a house, I negotiate the deal, I use solicitor. So if I want to buy these closed-end stocks and start foraying into this world, what are the people I need, and where do you suggest people like me start? Because I'm sure there'll be people listening to this as well going, okay, I like what he's saying. Now what do I do?
Well, okay, first of all, there for you in particular, as a real estate person, there are closed-end funds that have got to be a half a dozen, maybe more, that are real estate based. So if you want to dip your feet in, I would suggest to you that you look into those. And there's a website called CEF Connect, cefconnect.com, and it will list all the possible types of CEFs, and you can screen for any number of things, and you can get an idea of the yields. You can look inside and see what their description statements are, what they invested and how they invest. There are ones that do commercial real estate, ones that do land, you know, various types of real estate things, as well as bonds and as well as equities. And you can just look at those and, you know, and get your feet wet, you know, just like the people I was just talking about, this young couple that had, you know, they're trying to $800 out of their combined checkbooks a month. They were starting with just dipping their toes in the water and seeing how it worked out, watching the distributions come in every month and just getting a feel for it. And that's all you have to do. Anyone who gets started, I would certainly not say, you know, go out there and sell everything that you have now and throw it at this before you really get an understanding.
Yeah, if you said that to me, I'd be like, okay, no, this isn't the right one.
Yeah.
When you say, you know, $800 a month, I'm like, okay, again, you know, it's like there's something about sound, sensible, you know, like there's no hype. That's what I love about this conversation. There's no, you know, you'll be a millionaire in a year's time, which, so, you know, it happens in real estate, like in the property market in the UK. This promise of, riches. It's like Dick Whittington went to London looking for the streets paved with gold, and it just doesn't exist. And it's so nice to have a conversation where that's not, promised, because it's like, okay, this is probably, this is good.
Yeah, I think just like anything else that's new, you have to take baby steps and get into it. There's also there are 3 Facebook groups.
Mm-hmm.
There's my Facebook group is called the Retirement Income Independence Coach. A lot of words. The retirement.
That's okay. I'm just going to write it so that we make sure it goes in the notes afterwards so people can find you. The Retirement Income
Independence
Coach.
And it's a discussion group. And it's a discussion group that I designed pretty much for people who have read the book. So you can talk about the concepts and the principles and the QDI and, whatever you want to talk about. But you don't talk about individual issues. Because as a professional, I can't. I will not. I will not be a tipster. I will not. Brilliant. I'll show you where to go do your research. Yeah, I'll talk about the sectors, and everything follows the market. But so you could do your own research. Even when I have sell the universes, there's a caveat on top of it. This is for you to research. Do not go buy anything. Research them. See if they meet your requirements. So so that's one. There are 2 other Facebook groups. One is a discussion group, and you just say closed-end fund discussions. That actually talks about individual positions. I'm a member, but I don't own that one. So I still, even when I discuss things in there, I rarely say anything about individual positions. And then I have another group, and that's called Closed-End Funds for Retirement Income and Equity Trading. And again, that one does not talk about individual issues. It talks about concepts and principles and strategies and stuff like that.
Yeah.
But it's all about closed-end funds. So people can do that. CEF Connect is a good place, and of course the book itself.
Yeah, sure. And do you have the Facebook group? Can anyone join that, or is there a membership for that? How do you work?
There are questions. And, so we like you to, in all of them, we like you to answer the questions. And we ban anybody that advertises crypto or some other, are they going, and I have all my money with John Jones and he's made me millions, anybody does that, they get one shot, they do that once, they're gone. It's just about what we do.
It's really important to manage stuff like that, isn't it? To keep the integrity of the group. When you're doing this stuff. For
some of the groups, like you were saying, where people would spam you with those pictures that you were talking about.
Yeah.
I mean, I go on a group that's a dividend investors, and the second picture is one of those. Oh my God!
It's madness. It's madness.
Yeah, I don't want to post I'm not going to post this webcast on that place, right? Imagine you have your picture, and then the picture below you is. We don't want that, do we? You and I?
It's mad. It's madness.
Yeah. And some people don't manage their groups to get rid of those people. I get rid of even the good looking girls that say, "Oh, I like your profile in this. We could be friends." Bammo, banned. Oh boy.
Yeah, I don't get the ones from the girls. I don't know why. I get the ones they're always they say they are, I'm sure they're not, but they're ex-US military and divorced. That's the red flag for us women in the UK. I don't know why that is. I don't know why. And there's usually a picture of like in a military uniform. So
right.
Who knows? But apparently that's what people get into.
That's what gets you
mind blowing. And as far as in property, there's a team, we've got estate agents and solicitors and all of that world. So in this world, who would be on my team if I was going, okay, I'm going to do this, and you do the coaching side of it. So is it then a broker that understands it? Because you kind of alluded to, whoever ends up. So there's a literal transaction of purchasing things. So how do you recommend people go about that? What do you say about that?
Most of the people that are in my groups and the people that I've dealt with for coaching are using the online brokers. And I don't know I'm sure you can do Fidelity and Schwab and things like that. And those are the most common ones that I see. I use Fidelity myself. And
so then you're actually being able to do it yourself. Literally just have an account and just say, this is what I want because I've done X, Y, Z.
Right.
Yeah.
Right.
Okay,
and all the and a lot of people have discussed the mechanics. And even if you have mechanical questions like that, you can put them in the groups. I mean, these guys are good. I started my first group, the retirement income group. I started in 2020. So the people, there's about maybe 2,300 people in it. And it's got a lot of people that I would say are qualified to say, yeah, we do it this way, we do it that way. A lot of them say we do it Steve's way, we don't do it Steve's way.
Yeah, but when it's a well-managed group, you can trust that conversation, right? If you're managing the group well, and commenting, and it's your group, then there's a level of trust that the conversations are usually of a higher standard.
Yeah, I don't like them to post articles unless I see the articles first, and sometimes I'll take things down. But if it's somebody I know, I'll just talk to them and say, hey, I took this down because it mentioned these 3 specific securities in a positive, negative light. So trying to influence people about the individual securities, and I don't need that on my groups. So.
Yeah. It's really interesting.
So that's the sources of information you have. There are articles in Seeking Alpha. I don't like Seeking Alpha. I actually used to post a lot of articles there, and then they started editing me. And if I said something that they didn't agree with, they wouldn't let me publish it. And I said, I'm sorry, I disagree with you, but I'm not going to publish it with what you think. I'm going to publish it with what I think. And if you don't want me, you don't want me. So they don't take me anymore because I'm different.
Wow. What is Seeking Alpha? Is that I've not heard of that. Is that a place where people can post things?
Think Alpha is sort of this magical, mystical place you want to get as an investor where all the forces of nature come together and everything is perfect. And, if you study the charts and you keep all these statistics, you will be able to have that first crystal ball that can tell you what's going to happen in the stock market tomorrow. And I just think a lot of what they say is just, BS. A lot of the people are trying to get their approach adopted by others, as I am with my approach. But unfortunately, my approach works. Come on. My approach, but let me say, my approach is one different and distinctly unique a way of doing this that not many people yet are familiar with. And, I'd say it's worked well for me and for a lot of other people. And I think you can get into conversations with those people in those groups we just mentioned. And you may decide that it's for you, you may not. You can always come and have a coaching session and we can talk about it.
Yeah, absolutely. Right. And I think that's the difference. I think, when we're talking about everyone's got their own approach that they're selling, there's a difference between selling and, I do this when I coach people in property. I do less property coaching now, but it's like when I do, I'm not part of the deal. I'm not selling the deal. I don't make any money out of their deal. And it's like when you can be removed like that and say, look, I'm, almost like a silent partner without any benefit. It's a very different conversation to, just do it like this and buy this specific property, or I'll sell you this, or we'll, my other company over here will support you to do this and I'll benefit from it. It's a very different message because things get really, really mixed up, and really messy. Whereas when you're getting paid to coach, it's a different thing. So, and it's a different message. And when you're refusing to get drawn on which stock or the best way or the only way, because you're like, well, there isn't a best way or an only way. Do the research, make sure it's aligned with you. It's a very different message.
When you go into when you start focusing on income, you have to stop focusing on market value. And if you want to stop focusing on market value, you absolutely have to have your quality and diversification and income totally under management, under control. And we were talking about how long it takes to do this. I think it's one of the questions I haven't answered yet. It takes me, after the market closes, I go through and I get my orders in my mind for the next day. So I put them down on a worksheet. And I don't know if you can, but on the left are the things that I intend to sell today. And I told my broker, since I was going to be busy, it's market's open, that take my 3 top profits. I don't care what they are. I'm going to take my 3 top profits. These are, if you once you get into this process, you buy the number of stocks. The amount of your initial investment will vary depending with where we are in the market cycle. So if we're in the equities, we're in the upper areas of market cycle right now. So you'll buy less of the position now. And when we're down market, we buy more of a position down. I think I said the opposite of that a little earlier, so I apologize. But when market is down, you might buy a little more because you know it's going to go. Eventually, it will go up.
You hope it's going to go up.
So that's part of the process. So doing that, you're going to wind up like different apartments in a building bought at different times, have a different cost basis. So as the market rises, the most recent one you purchase might have that 3 or 4% profit in it, whereas the entire building does not. So I sell that one to take that profit because I still have others that I can buy or add to. So that's this column over here. If these particular positions, and I know they can't read the actual symbols, so I can do this.
No, that's okay.
Those are the ones that I'm looking at that are within bigger positions that I can take profits on if the price is right today. And then finally over here is a list of 10 different securities I'm buying. And I do that every evening, unless we have plans for dinner or something. Then I do it early in the morning. But that's it. And then I'll call my broker, and I still have to place it through the broker because as part of my sale agreement, you have to make sure you're not going to do business against them or encourage their clients to leave. So I have a whole year. It's driving me nuts to have to pay a management fee to manage my own portfolio.
To tell them what to do.
And I get charged a fee.
You get charged for telling them, I'd like you to do this, please.
Right. So that's going to be over in May, and then I'll probably stay with Fidelity, and I'll probably continue to work as a consultant with my old group. But I handle, like I got a call from one of my old clients at dinner time yesterday, and she's talking, oh my God, the bank did this to me. And I said, Colleen, let's come on in and we'll talk about it. I said, I can't do anything specifically for you, but I can talk to them and help you get around this. And she had something mixed up, but that, I'm there for them, my old clients in that way.
Because it's a massive relationship, right? It's like,
the
span over decades. You've watched people's kids grow up, and presumably their kids have kids, and all of that world. If you started off with, and I just want to underline this for people listening, you started off with 2 people who gave you $20,000 each,
$25,000, something like that.
$25,000, and it's like that. And I want to underline this for people as well, just not in an investing point of view. I talk about this all the time with my membership. It's like when they're thinking about marketing or business, it's like when your friends and family trust what you're doing and will put money into you, that's when you're on the right track, because then they tell their friends and their family, and it works. And when you have relationships that span decades, that's when there's something's going right. People who have got a relationship that's 1 or 2 years and then they're off to the next one and new clients and all that, it's like, well, why? What happened?
Yeah. The book is dedicated to those two guys that I
Wow.
started with
Awesome.
that are still there.
Yeah.
Yeah.
You haven't got the audiobook, have you? Are you going to record the audiobook?
The book is written in a different style. It's written as a conversation between myself and a couple that we meet on a vacation. And the basic premise is they had to sell significant amount of their mutual funds to pay for this, this luxurious trip we took to Amsterdam and up the river to Switzerland. It's part true and part. I changed the names, I changed the locations, stuff like this.
Yeah.
I changed it to Amsterdam because I had so many people helping me with the book that were from Amsterdam. And we have a lot of, in my age group, there's a lot of people who don't want to hear about Vietnam, which is where the couple and I actually met.
Wow. Yeah.
So we changed things and just went through the whole Q&A, just like you and I are doing now. It was a 2 or 3 or 4 meeting Q&A where we broke down all these principles of investment. We talked about the problems with buy and hold, the problems with dividend reinvestment programs. What about leverage? What about those types of things with closed-end funds? And just covered all the bases, and then compared portfolios to their own portfolios, or to SPY or BND, which is a bond indicating thing. So it's a conversation. So that's how the book took place.
Yeah. I'm asking for purely personal reasons that I devour books by audio while I'm walking the dog or cooking or driving or whatever, so I can get all this information.
And apparently it's pretty expensive to do this. It's got to be a recording, and it's my voice, and I'm not particularly. I don't like my voice a whole lot, but it would have to have this couple's voices, my wife's voice is in it occasionally. Time I do a Q&A with a Facebook group, and there's like 25 questions from 25 different voices.
Different people.
It would be and their charts. You have to show how
you almost need both. It's the kind of book that I would do both, right? I'd have the audio and I'd keep the book for.
I'd get sued for causing accidents because the chart would show up on your screen. You go off the road, and I'd be through. I'd be finished.
Yeah.
No, but I'm willing to bet. I'm willing to bet that 25 or 30% of the people who buy the ebook go right out and buy the paperback afterwards.
Yeah. It's
because
it's good to know that, right? Because you need it as a reference to be able to go back and forth. It's that kind of book for sure. For sure.
I mean, in the Facebook groups, you'll hear from people that have read it twice or 3 times already. Because I got to go back and check this out. I got to go back and do this but it's not nearly as textbook like as my first book. My first book, you want to know about bonds? I had a section. This is what a bond is. This is what a mortgage. This is what a loan. And I really went through all that stuff in detail like a textbook. And
it's really valuable though, right? It's really useful because when do we learn it? We're not taught it in school.
Nobody gets it. I mean, I always say that when my wife and I got out of high school, most of our classmates couldn't balance a checkbook because they weren't taught anything practical like that. Today, I hope they do a little better job, but I don't know.
I'm not convinced they do. I think it's getting better. I've got a friend's daughter. She is actually doing financial something or other as a GCSE, which is our high school kind of level. So it's sort of getting better. But when she was showing me the work, I was like, "That's so boring. Like the way it's been written is so not real life. It's a bit like learning a language in school versus going to a country. It's kind of you learn it in a way that's not really real, which is why it's great that you're doing what you're doing. Because otherwise, if you don't, who does?
This book is very real. I mean, it's like that. It's you and I talking. It was me and them talking. It's that type of thing. I liked it. I mean, it wasn't my writer. I had a ghostwriter, and she was just fantastic.
Ghostwriters are magical people, though. I've got Vicky, she does some of my posts on social media and things, and she's like a ghostwriter. But when I read it, I go, I would have written it like that.
Isn't that phenomenal?
People.
It is, because they can take an interview.
Yeah,
they can take an interview like this and put a conversation in my voice. She'll maybe she'll throw in a Midwestern phrase that she might use, and I wouldn't say that, but it was really interesting working with her. She's still a good friend, so she's one of the voices in the Facebook group. Actually. Yeah.
So. And I think that's really what makes it really nice as well, like having this conversation and reading your book, and then you've got a Facebook group. There's a humanness. There's something that's going on at the moment where there's so much AI and tech and inhumanness to where our lives are going. To actually be able to talk to you, have it on video, people be able to see you, have your book, and get that there's a human behind the book and understand, and then there's a Facebook group with conversations. I think that's really powerful now, more than ever now.
I got a phone call last night. We were sitting watching TV, and I get a phone call. Oh, it's you? He said, I thought I was going to get an answering machine. I didn't know I was going to be disturbing you. I said, no, you haven't disturbed me. It was really crazy like that. But anyway.
Yeah, but that's where we're going, right? That's where it's kind of like what's real, what's not, all of that. I mean, I had a LinkedIn message the other day from a client that I thought that message was a bit odd, because we work together all the time. So I messaged her back through LinkedIn. I hardly ever go on there. It's one of these places I'm there because you're supposed to be on there, and I rarely go on there. So I went on, sorry, I missed your message. I hardly ever come on here. She went, oh, sorry, that was AI. That wasn't me. And I was just like, it makes me want to not come on here even more now, because there's robots messaging me on behalf of humans.
I don't talk to robots on the phone. I just won't. But I will be posting this particular interview on LinkedIn and Facebook.
Same. Well, it's streaming now as well. So it's
on LinkedIn now. It's already on LinkedIn.
Yeah.
I'm going to post it anyway. So.
Yeah, definitely.
And that's right. You told me earlier we were live right now. Now I'm going to get nervous. I'm going to instantly watch every word down. Very careful.
Don't. I think it's one of those things. Doing podcasts and doing videos, because you said it earlier, I really like my own voice, and it's really interesting how, like, I used to hate my own voice, and then the more video I did and the more stuff I did, to the point now where I need to record the audio of my book. And I'm like, I can't not do mine, because people say, when I'm at the checkout, I've got your voice in my head saying, do you really need that? Are you sure you want to buy that? So there's a dance as well, because actually when you start to be with humans and they know your voice, if they then get your audio book and it's not you, it's really discombobulating, because they're really used to your voice. So it's that dance.
I haven't heard that word in a long time. Discombobulating.
Discombobulating. It's one of my favorite words.
Heard that recently.
I've used it a lot since having kids.
Do you know the word? Do you know the word feckless? Feckless?
No, I've heard it. I couldn't tell you what it means, though.
It's usually used in reference to politicians.
Yeah.
Like they're really kind of useless or confused.
Yeah.
That's one of my favorite words.
What are the discombobulating. It's one of my favorite words. Especially since having kids, I found that very discombobulating. Life was pretty simple before that. So we were talking about time, and you were saying, like, you check the markets every day, and internally I'm going, God, I could never do that. But I'm also then taken back to, the clients you were speaking to, and they've got $800 a month and they get their paycheck, and then they're like, right, I'm going to invest this. So presumably, what are they doing? Are they doing it once a month? I just want to give people a sense of, it's the same in property, right? There's a range. Like, I could go on Rightmove every day, look at properties, and it'd be no big deal. If I said that to a client, they'd be like, oh my God, I don't have that time. But it's all about what we used to, right?
I got the impression that it was that they they did the new buying and adding of money once a month for paychecks, and that they watched carefully for profit taking all the time. Like when she had a minute, and they put in orders so that the orders can she does it. She said she does it in the cafeteria when she gets a break, or she can do it all on her phone these days.
And is that so? So when people are watching, they're looking. Where are they watching that? So if say you're buying on Fidelity, would you then be watching on Fidelity as well, or
Yeah,
you're watching it? So you're just literally watching your own stuff on your own account.
The Fidelity app will give you your portfolio. It give you a place you can buy and sell securities, and it's right there in your hand, and you can push the right buttons and buy and sell.
It's
and stuff like
amazing,
that.
isn't it?
I haven't started. I'm looking forward to doing it when I get to May. But you can do all that, and you can. I tell her, look, just she was a very hyper woman, very, I really was impressed with her accomplishments. Being a PA and in transplants. A physician's assistant in the transplant field. My God, the knowledge and skills she must have. But she's very excited. So I said, well, you got to tone down that enthusiasm and make sure you're not letting your emotions.
Using this. Yeah, the emotions are a big one, right?
Yeah, you got to just keep it between your ears. The emotion part of the brain, don't let that get in there. But she was cool. Yeah. And that's what I would say most of the new people are doing. And now they've gotten in. There's so many of them that use spreadsheets and they go on and you can make up charts. You can put your own symbols in and do charts and things in the on Yahoo Finance or whatever, anything you have. So they really go into a lot of detail. I'm not a tech guy. I don't look at the past to try to predict the future. I look at the past to see what the trends are. And if something's within its normal trading range, and if it's not, is it because we've had 10 years of historically low interest rates? Could that be the reason? Yeah, that's the reason that the prices are now down here and not up there, stuff like that. So, but to see that what you want to see when you're managing a large number of properties or a large number of securities is you want to see that in general, it's like the tide. Things that happen in the outside world will either raise all the prices or lower all the prices. If there's any one security in a rising market that's going down, you better look at that one, to see what's going on here.
Yeah,
Yeah. I mean, if it's a sector, like if it's the oil sector, when there's a glut, or it's the oil sector that's going up because the cartel has cut production, you can understand why that sector may go one way differently from the tide, but not by massive amounts. So particularly when you have a large number of securities like I manage, that's what I'm looking for. So when I look at those things and I see this one's down 3% today and everything else is up, I want to look at that one and say, okay, what happened? Did they cut their dividend? Is somebody trying to take them over? This, that, is it some, and if I can find out. Those things don't happen very often in these because they're, the average number of positions. It's like, again, you use real estate. If you had a portfolio of 300 different properties, not one of them going to zero is not going to hurt you financially. And that's what I like. So it's almost like you take diversification, which which you're doing, and I do diversification. But I'm doing diversification. I have over 200 positions. So what I feel that I've done is diversification has always been thought of like a defense mechanism. It gives you that security that you have all these things going on so that something's always doing good. And if one thing does bad, it's not going to kill you. So it was always a defense against risk. Okay. Yeah. So I feel that I've taken diversification and turned it into an offensive weapon because I own everything. I mean, I own CEFs that have some gold in them. I mean, maybe one. I own every sector you can imagine. I don't own anything with Bitcoin in it. I have not done that. I won't do that. But I have a the entire world economy is on my desktop right there.
Yeah.
I push a button and I can buy that one. I know the average yield is 9% or 10% or whatever. So if I sell something, I almost can blindly hit another button and know that I've replaced my 9% investment with another 9% investment. And in the meantime, I've got that extra profit adding to my capital. So eventually I'll have enough capital to buy another apartment or another, you know what I'm saying? So I've taken diversification to a whole nother level in my mind. In my mind, anyway.
And how, no, I totally get it. And how, so bringing it back to property and real estate. So I remember when I first started out and I had 2 or 3 houses, like right in the early days. And one of them needed a full refurb because the tenant had, been neglectful rather than malicious, but the result's the same. It needs a full refurb. And it really hurt because it didn't have 15 or 20 or 25 where, now if one needs a refurb, it's no big deal. It comes out of 1 month's cash flow. It's no problem. I hardly, really break a sweat. It's a bit of a pain, but that's about it. Whereas at the beginning, it was like, oh, how do people starting out? So let's say I go, okay, I'm really interested in this. How would I, or how would anyone listening to this who says, all right, I'm gonna put a few £100 or dollars a month into this and start testing it. How do you recommend people do diversify with that small amount of money in the beginning? Like, what are they doing? Or is it that the fund is diversified by its nature? So then everything, even a couple of £100 or dollars bought is diversified.
Yes, and yes.
Okay.
Yes, each fund is diversified, particularly if you've taken them from the list, the universe that I use. Because the minimum is 50 different positions in each one. And the average is over 200. Okay. So you're getting diversification. But the other diversification from having multiple sectors and multiple types, like you want some in real estate, you want some in healthcare, you want some in corporate bonds, you blah, blah, blah. Do what those kids were doing, what those young people were doing. Buy a whole bunch each month because the prices of these shares, the average price is less than $20. Unlike the stock market, where your average price these days might be $80. You can get 100 shares, for $700. You can get some even cheaper than that. And they all qualify with all the rules that I've set up for them and all the guidelines. So, I would say, your first $500 you might get one, but get a different one next time and next time and next time. And keep doing that and adding to the portfolio and starting from scratch. If you're rolling over 401k you have from an ex-employer, I don't know if that applies here, but if you've got an inheritance, or if you've got an existing portfolio and you want to get your feet wet in this, you just got to either set it up in a separate account, or if you use an advisor, if you use an advisor, you just tell them what you want to do. You want to start to experiment with this type of income producing security. Help me out. And if he says, no, I can't do that, then you say, okay, goodbye.
Yeah, it's not the right. Yeah.
Until you find somebody that does. That's all. So the time is going to vary. When you first get started, you're going to be pulling your hair out like anybody else because it's new and it's different.
Yeah.
But I think those groups are a good place to start. Say, hey, I'm a newbie here. What should I do first? I got $1,000 to invest. Do I buy 4 different things for $250 each, or do I buy 2, or do I buy 1 and then get another $1,000 and buy a different one? Give me some help here, and they'll help
you. Yeah, that's brilliant. What would you say what are the downsides? So if I go and buy a house, I know the potential downsides. Tenant could trash the property, tenant could stop paying the rent, the government could change the laws, which they did recently. The tax laws all got shifted on us, which turned my portfolio upside down. I know what the downsides are. So what would you say to people are the main risks, which it sounds like you're mitigating an enormous amount just by your pillars. There's a huge amount of risk that's just taken out of the game from the get-go, from what you're saying, similar to how I do property.
The pillars, there are many types of risk.
Yeah.
There's financial risk, and that's the single most important one. What financial risk means is, what is the danger of this investment going to zero? That's financial risk. You burn down one of your apartments that had no insurance. That's financial risk. You have market risk. And that's whatever causes the market value to go up and down. It's really not a risk at all. That's the way the world is. You have interest rate expectation risk. If they say interest rates are going to go down, these prices of interest rate sensitive securities are going to go up, regardless of what else is going on with the market or anything. So that's just three. Then you have other things like weather and healthcare and politics and international wars. And there's so many different things affecting the market values that you can't predict. The one you have to protect against is financial risk. And that's what those pillars take care of. The downside is that every time interest rates go up, these things pay more income than any other type of security on average. And so they are going to be most impacted by changes in interest rate expectations, because most people are buying these for the income, just like I am.
Yeah.
Okay. So you understand that, and you try to take advantage of it by never getting your portfolio too heavy at any one security, because they're going to go down if interest rates change. So you want to be able to add to them to take advantage of that. So that's one of the key processes to protect yourself and to take advantage of changes in market price. The other thing in this type of security that you have to understand, they're closed-end funds, meaning that the initial public offering is pretty much going to be the total number of shares they're going to have outstanding. And that number of shares is far less than common stocks that they own, far less than ETFs, which manufacture shares anytime they want to, and mutual funds, which add and subtract every day depending on the whims of the public. And if it's time of greed, they're throwing more shares in there. If it's time of fear, they're taking shares out of the market. So these shares stay the same. There's only one way that they add shares to their positions, and that's by what they call rights offerings occasionally. And it's pretty much the same group of accounts. But there's not a whole lot other than that you have to worry about with these things. That's going to follow the general flow of the bond market and the stock market, a combination of the two, because even the ones that are primarily equities have some bonds in them. Many of the ones that are primarily bonds have some stocks in them. So there are a lot of ones that are mixture. My equity universe contains any of them that have at least 65% in the stock market. That's my cutoff for that distinction. But there are so many. There are convertible shares, and there are preferred shares. So there's a wide variety, and you don't have that worry about the Payne Stewart scenario. Payne Stewart was a golfer, American pro golfer, and a bunch of years ago, he was in a private plane, and for some reason, it got the oxygen left, and he died, and the plane just continued on and crashed. And he was gone, just like that, a hero. I mean, it wasn't a Masters winner. I mean, this guy, what if it, and I said in an article, I said, what if that had been Bill Gates? Because that was when Microsoft was really on its roll. I said, what if that had been Bill Gates? What would have happened to your nest egg that's 50% in Microsoft? So it all comes down to diversification and knowing that you have no clue what's going to happen next. You got to know that you don't know. And that's
I like
the way
that.
to sort of keep your risk at its minimum. No, KNOW, and no love. No love. You cannot love a security and keep it forever. It's not like a marriage. No. You got to be willing to sell. And my securities, every security is for sale every day, all the time. You give me my price, I'm selling it. I'm a Walmart. I'm a Walmart that deals in closed-end funds. I've got 200 different products on my shelf. You come into my store, you want to buy one for my markup, you got it, baby. You got it. I'm not gonna say, no, I'm waiting for the guy to come in tomorrow. It's going to give me more money. Nah, no, you don't do that. That's what it is. Think of your portfolio like you would you own a retail store of some kind. And the operation of it will be that way. How you operate it once you own the things. But get it diversified. You want to satisfy all the clientele. So you want to have as many different things in there as you can. But starting, anything you start in life, you got to start slow. My dad took my money when I was 12, and he gave it to his attorney, and his attorney invested for him. Before that, I had a couple bucks in a savings account. I said, oh my God, I got some interest. So even if that's where you start, but you got to start. You got to start. And when you start investing seriously, always try to keep at least 30% of your money focused on income. So if you're going to do individual equities and you don't want to follow my guidelines and make sure they pay a dividend, good dividend stocks, you want to go elsewhere, at least keep 30% of your assets pushing income into to reinvest with. Because if you get a chance to go on a ski vacation with that $2,500 you usually put in the market, you're going to go on the vacation. So keep some in income, keep growing that income section. I use another thing that most, you've heard me say how I feel about market value analysis. But there is a way of looking at your portfolio to see if all this stuff I'm talking about really works. So in addition to those 4 pillars, and we've talked about the 5th principle is that understanding there's a market cycle and that the waves, individual stocks, groups of stocks, sectors, markets, they all have cycles. Understanding that they exist, and you can get any chart and you can see where you are now. You can tell if you're near the top or near the bottom, and you take your guidance from that. But the other one, the final one, is your focus. What am I trying to accomplish here? What are you trying to accomplish? You want to get as much income from these properties as you can, net. Okay? And I say net because you and I both talked about the amount of expenses there are in real estate. So let's say I could have a half a dozen real estate closed-end funds, and I'm just getting that 8% or 9% income with no expenses. If I'm not getting my portfolio management, but in the overall scheme of things, what you want to focus on is your income growth, because if you reinvest at least 70% of that income, your income's going to increase your capital investment. Our cost basis of your buildings, our cost basis is going to go up, and it's that cost basis, it's that capital investment that's producing the income. I mean, you own the building, it produces rent. If you just have a higher value in your building, it's not helping your rent.
Doesn't matter,
Doesn't do a thing for you. Okay, so that's the 2 things you got to look at. Am I growing my income quarter to quarter, year to year? Am I growing my capital quarter to quarter, year to year? How many houses and hotels do I have on that monopoly board compared to this time last year? There's got to be more, or else I'm doing something wrong.
Yeah. And there's what I'm getting from this conversation is there's a lot more fluidity, like it's a lot more liquid right? So property's very slow, it's very
no.
long. It's a long time to get in. The thought of selling anything is just like,
You got
whereas with this,
you got
you know,
lawyers, you got
oh,
agents, you got
oh,
this,
don't, I know.
yeah. Like I said, I wouldn't be where I am today if my father wasn't a real estate mogul of sorts in a small community. I wouldn't have gotten either the back of your head knowledge that income is so important, or the idea. I mean, he used to sell his stuff, or the idea that selling an asset is okay. That type of stuff. I wouldn't be there without his real estate in my blood. But I think I have taken it to a different level, because just like you have those types of expenses, I'm occasionally going to experience a loss because I'm in the marketplace. But it's not going to be as high as the net expenses of other types of investments if you do them on your own, and the income is going to pretty much offset it. So I'm going to grow that capital every year. And that's where you want to go. You want that capital growth and income growth.
Yeah, and the difference with what you're doing is the capital growth's moving around, so the income's going up as well, whereas with the rental property, it's very static. So the capital grows, but to sell that and then put that money into something else, the costs are so prohibitive, it's often not worth doing. So then, it's like, that's what I'm experiencing. I've been in it for 21 years now. So I'm in that. I've been in it long enough to go, I don't want to sell these, but they probably should get sold now. But the costs are so prohibitive of selling, paying the tax, and then buying something new. It's not worth selling, but it's also not worth keeping. And it's that's the difference I'm hearing in this is you just got that way to stay a bit more fluid, which I'm sure Matt Goodley, my friend who's a financial advisor, he'll go, finally she's seeing the light, because he's probably been trying to tell me this for the last 20 years.
That's the guy you were talking about before, right? I was saying he does.
He'll totally say, she's seen the light at last.
You got to buy him. You have to buy him a copy of the book.
Yeah. No, I totally don't. I'm going to tell him to listen to this, and he'll go, thank God someone knocked some sense into you. I've been telling you that for years.
But, so back to your situation, or a situation who's a real estate investor. I had this discussion with this guy, Breslin, and he was saying, I get a lot of people that I deal with that are older people. They own a lot of real estate, and they're talking about, my son doesn't want anything to do with this, and my daughter's so busy with her career.
Yeah.
How can I give them these 4 different apartments that I have as rental properties? What are they going to do with them? So we were talking about, there's a point in time in a real estate investor's life. There's going to be, you're obviously going to have you can not buy that next one and start an investment portfolio that will produce income without the overhead. But for the older person, the older people out there listening to this and having that very same dilemma right now, and we're not at a low, I don't know about over there, but we're certainly not at a low level in real estate prices right now. I mean, my wife and I are talking about, capitalizing the gains in our property and going someplace else and downsizing and stuff like that. But, pulling the trigger is tough when you're, it just is. And, but what if it's that second home? What if it's that other rental property? Now that's different. You can capitalize on that, and you can reinvest that money in a situation such as I'm describing, and probably improve on the income net over time. I don't know the exact numbers, how much the overhead cuts into the profit. If your profit's 10% or more a year, I don't know, but it certainly has less aggravation associated with it.
Well, I think that's the thing as well, right? It's not just the financial cost, it's the time cost and the headspace cost and the worry cost and the, when's, like last night, one of my husband's houses, the toilet broke. It's like, it's the time, and it's 9:00 in the evening. He's a helicopter engineer. So he'd been up in the night before. He's exhausted. He's trying to go to bed, phone call, toilets leaking all over the house, and it's like, at that point, it was nothing to do with the money. It was that it's 9 o'clock at night. I want to go to bed. I don't need this right now type phone call. That the more properties we have, the more often that happens. 5 a.m. on New Year's Day, another toilet issue. It's like it's that. I think it gets to a point for us anyway where we go, if we keep buying more, we just end up with more of these phone calls, and we don't want these phone calls anymore because it's not the cost anymore, it's the time is valuable.
The other thing you could do is get a management company, but that's got a cost, of course.
But it costs, right? And then it makes the investment not so great. So it's that, if we said,
so you got to
rental,
you have to diversify. You have to you have to start diversifying. And you're at the perfect time in life where you could probably afford to set aside some money and start building a secondary portfolio for income.
Yeah, absolutely. Well, and even, as we're talking, I'm thinking about clients, even my mum. My grandma passed away this time last year, and my mum's 70. She's got now a lump sum, some of which she's given to me and I've put into my portfolio and, paying down debt. But it's like, she's going, what do I do with it? They've sold out of their rental property. They don't want to deal with the hassle anymore. Where do they put it? So even this, I'm like, right, this recording needs to go to them because it's a big problem for people of where to put it. That they trust and that they understand and that it's supported. And just going to, it's that age-old thing. If you go to a hairdresser, they're going to tell you need a haircut. If you go to a stockbroker, without this conversation and the education and the understanding, well, they're going to sell you stocks. Are they the right ones? Are they not? Well, they're based on what's right for them, not what's right for us. So, this conversation is so valuable. It's so important for people, like generally, because what are you going to do? The state pensions aren't working. Pensions generally don't do what they used to do as a return. So there has to be a responsibility taking on an individual level to understand like what's gonna work, rather than handing it over to a big corporation who says, yeah, just give us your money, we'll look after you. I think that's what I find so empowering in this conversation.
Well, yeah, it's a way to self-manage or direct your advisor to manage, in a way that provides the income that you need, as opposed to the old 4% rule logic that most advisors use. That, well, the market's going to go up, so we'll just sell stuff to give you the money you need. Approach, because that doesn't work when you have a 2-year correction and stuff like that. Yeah, definitely. And then, so ongoing, what do people then do longer term with like you're carrying on, right? There's no stopping. What will you, and you can tell me to mind my own business or put it not about you personally. What do people do with these? So with real estate, right? So we've got 2 sons. We're like, God, I hope they like property when they grow older. Otherwise, we're going to have to sell a load of stuff. And I know so many landlords who have done exactly what you said. They've got a property portfolio. They're like, yes, they're going to give it to their kids. And their kids are going, Jesus, I don't want that. I've grown up watching you go to a toilet call out at 9 o'clock at night. I don't want your properties. Thank you very much. So with the stock side of it, how would you deal with that from a dying point of view, like within your will? And how do you see that? Do you see that as much easier than, I'm assuming it's much easier than property, but how do you deal with that? Because it's really, we have trusts between the 2 of us. And then we have our daughter is going to be the lead person when we go, and she's going to divvy it up. But they know who to talk to get it done my way. Because my old firm, they're still friendly with them and everything. But most people, you're right. Most people will have to find somebody else or direct somebody else to do it in a certain manner, even if they are do-it-yourself investors. The system itself, the securities themselves survive your death, and they can be just passed on to the next generation. And I'm sure my son will just say, hey, Amy, can you just move move their money, put it in my name. Don't change a thing. Do it the same way. And that's what they're going to say because they know that they can use the income from it. My daughter might be a little different. She might want to upgrade her life a little bit more than, the personality's that way. And the grandkids, well, we'll take care of them too. But again, they're, my granddaughter has the book with her at school right now, and I said, you got to read it. We are not immortal, neither us. And your grandmother doesn't know enough about this, so you got to read this book because you're going to be responsible for a lot of money someday. So you just need to know what I do.
And understand it.
Yeah. So there's those legacy problems of, where does the wealth go? What I do certainly can make a person, if they use this long enough, they're going to certainly be able to take care of themselves and take care of all the income they need. But then they're going to have to pass that along. So they have to pass the knowledge along with it.
Yeah. Yeah. It's so important, isn't it? So important. What do you so here's a question. When my grandmother passed away as well, and my auntie went to my grandma had stocks and shares with a broker, big Bruin Dolphin. It's a big, I don't know whether they're worldwide or they're a UK firm, but basically she went to them and everything had to be sold and split up. That meant that, my mum and her two sisters, they were two smaller clients for this brokerage. Once that pot had been split between the three, they're too small. But what was interesting was my auntie had a conversation, my auntie Sarah, saying, what about if I don't want to be in any form of defense or war or pharmaceuticals or oil and gas?
My
this
God.
like ethical, right? Exactly, right? It's like, well, so basically the broker said, well, you're not going to make any money. Short version. I mean, that's it, right? That's the whole deal. It's like those companies make the money. And how, I don't know, what do you say to that? Or is that's just the way it is? It's like, if you
I always used to say
I
used to always say to my niece, who I was investing for a while, said to her, Becky, those are the types of things you do with your vote and your political influence. You influence your politicians and your government to take care of those types of things. You don't do it with your dollars because you can't have enough control. Today there are, and they're on my list. There's 2 or 3 impact closed-end funds, environment and so forth, that type of thing, that are trying to invest green or whatever you want to call it. But as a strategy, if you're just going into the stock market and stuff like that, what the guy said was correct. You're not going to make any money. You're not going to get the income you need. And if you were to do it just in these 2 or 3 closed-end funds, then you have a very poorly diversified portfolio. And depending on who's where, how much attention those types of issues are going to get politically is what really is important. So that's
what
where
makes the difference.
You have to invest your time in your government to influence that type of stuff, not your pocketbook.
Yeah, it's really interesting. Yeah, I thought you would probably say, I like the political thing. I hadn't thought of it like that before, but it is that dance, just like dealing with reality. It's like, if you want to make money and you want to be in the stock market, that's the whole deal right there. But actually, I'd say we're probably more disempowered politically than we've ever been of actually like having those conversations and standing for stuff. And
I mean, you have to say to yourself, who's going to be making the decisions that impact the environment? Who is going to be making decisions that is in a denier that there's becoming a change in our environment? Who do you want making the choices of how our government works? I mean, you probably have some guys out there in our instance. I've heard people talking about getting rid of Social Security, stuff like that, when they're the guys that stole all the money out of the trust fund in the first place.
Yeah.
I tell you, my wife and I have said, depending on what happens, I mean, we may wind up living in Europe. We may wind up in a place in
really? Wow.
Yeah, Like we're going to Portugal in April, and I wouldn't be a bit surprised if we didn't take a look at some real estate.
Yeah. And that's because of the way the politics are and the way the US is at the moment.
Yeah.
Yeah.
But we weren't going to talk about politics. Yeah.
No, we won't. Apparently, it's we could.
What have we not covered?
That's what I was just wondering. That was one of my ponderings. So is the ethics and the morals and all of that world, which does take us into a political conversation. Maybe we've covered everything for now. Do you know there's a few things I'd love to follow up. Not necessarily now, but there's a few. My mind, when I have these conversations with people, I start thinking, oh, okay, bang, that's interesting. I know there's a few of my clients who are going to listen to this. Go on, tell me. And I was going to say,
I got one. I got one, and it's right there on the screen where it says financial freedom.
Yeah.
And I talk about, in fact, the subtitle of the book is A Financial Insider's Guide to Income Independence. So income independence, what is it? What is it really? I mean, I feel like Sandy says, when are we going to Japan? And I can say to her, well, let's go, early in 2025. And neither of us will say it's what it's going to cost. That's income independence. I know that we can do that, and I won't have to sell anything to pay for it. Okay. You might say, when does Johnny go in his first year of college? And of course, it's better in Europe where it's not nearly as expensive as in the United States, but still,
it's not that far behind either. It's going. I mean, Owen and ours are in private school already, so we're already taking fairly big hits on a monthly basis. But
you say, like I say, I told my granddaughter years ago, whatever you want to do, I'll take care of the education expense. You just do it. Yeah. And because you can. So you want to be in a possession where you can do that if you want to do it. You want to travel, you want to take care of your children or grandchildren, you want to take care of a local charity without hurting your own existence. Income independence to me is that ability, and I can sum it up. I sum it up like this. I say neither a market crash or rising interest rates will negatively impact the income that I produce. Yeah. And over the years, if you looked at closed-end funds, if you looked at an income approach, you'd see that that's true. The distributions, for the most part, even from individual companies, don't change that much, regardless of those characteristics. But then I go on to say, in fact, if either of those things happen, it's going to actually help me grow my income and grow my capital, because I've then got sources to put it at a higher yield. So that's where you want to be. You don't want to say, oh my God, the market crashed today. I say, holy mackerel, we got some opportunities.
Let's go shopping.
Let's go shop. Now there's something for you. Think about life, human life, the sales, the Christmas sales. They on November, right day after Thanksgiving, right? Black Friday, they are all going to the malls looking for the sales. Why can't you? That's the same exact mentality with the stock market.
And yet everybody does the opposite.
Everybody does that. They want to, when the market prices go down, they want to sell instead of buy, because they don't pay any attention to quality. The quality of income isn't in their buying apparatus, so they can't be comfortable when these events occur. So income independence, it's also that independence that you don't really care. Now, of course, there's some, if you happen to live in, in a country that goes into a civil war, I mean, everything goes to hell anyway, right? So it's not going to apply. But hopefully in our countries, our continents, can we say that? Our continents, yeah, pretty much. Ours, even ours. Hopefully in our continents that that's not going to happen again in a long time.
So. And never say never with everything that's going on.
Hopefully. Can't say never.
Crossed.
Yeah.
And it's such a big deal. And also, I don't know how you've experienced it with your clients and what you've seen over the years, but what I found for myself, because I was a chef, I wasn't earning huge amounts of money. It didn't take that much for me to retire. It was like £1,500 a month. I didn't need my job anymore. I didn't have a Ferrari on the drive, but my time was free. Like, there was no going to a job anymore. There was no 50, 60-hour weeks anymore. I'd bought back all of my time. And the biggest thing that I've noticed with my clients anyway is that they don't need as much as they think they do to initially free up their time to then be able to, like, you've still got all your time. And we were saying just before we came live, you've got to do something with your time. The margaritas on the beach only last so long. And then you go, what do you want to do? It's like, why you're doing this now. It's like, well, you want to do something. You're not going to sit around all day. Yes, you'd like to go and play golf and have some nice holidays, but you can't do that all the time.
Right.
And then time is freed up for us to do whatever we want. And it's a magical place. So I think there's a funny kind of, and I don't know whether it's social media that's done it more recently with, seeing the sheer wealth of some people, earning hundreds of thousands of pounds and dollars a week and thinking, oh, it's such an unachievable goal, so why bother? Whereas actually putting it away, starting small, like you said, you started with your, when you started your business, you started with 2 clients, $25,000 each. And now here you are after this massive career and millions under management. And I think I love that you've said that throughout this conversation. Like, just start small, because it's the getting people to start and systemizing of it and getting used to doing it. That all of a sudden, I remember when I was 32 and I suddenly went, I don't have to work anymore. And it was weird. I've been I missed my goal by 2 years. My dream was like, I'm gonna do it by 30.
Wow.
And I didn't, and 30 was chaos. I had horrific personal life circumstances that were chaos. So it was almost like I'd forgotten the game and then suddenly realized I'd done it and left my job. And it's almost unimaginable to explain to people. It's like the small increments, like just do it. And then all of a sudden the income's there, the capital's there. And then, that ability, like you say, Japan 2025, yeah, sure, no problem. Like, being able to do that is it's magical. Really, really magical. And so I guess what I'm saying in a long-winded way is thank you for sharing what you're doing and what you're saying. I'm like actually giving people the idea that it's possible as well. I think for me that's interesting because I'm in the property world. I watch how hard it is for people. I was very driven, so I did it. But I watch people who aren't so driven, and it makes it a lot harder to do if you're not really into it.
Right, I agree. You got to have that something in your genes that pushes
says we're going to do this.
Yeah.
And what you're sharing is, it's a way of doing that isn't all in and dealing with construction and builders and this house might fall down and
how about local regulations and stuff like that? My dad used to have to go to planning board meetings and stuff like that. Oh my God.
It's horrific. And it's getting worse, actually. That's the other thing that's happened, I think, in the last 20 years. We've had massive tax changes, which meant, I don't know if you know what happened in the UK. We had tax changes that meant rental income, if it came into your own name, was the mortgage interest was no longer deductible as an expense. So all of a sudden we had to pay tax on the entire rental amount minus the maintenance expenses. But the mortgage usually makes up 50% expenses of the turnover, right? So stuff like that changing, and now we've got huge regulations, coming. And for me and most of my clients, it doesn't matter because we do a high standard. So we're not worried. These regulations are coming in to kind of clean up the landlords that are really doing it terribly. But it still has a cost.
The slum landlords,
The slum landlords, but it still has a cost. Yeah, the slumlords, But it still has a cost to our businesses of, more compliance, more this, more that, more certificates, more proving, all of that. So even though we're doing it anyway, it's like that level of red tape and paperwork. So it's nice when there are options on the table for people to actually start small and start with 100 or 500 or 1,000 a month, wherever they're at.
Yeah, that's good. It's
Makes
certainly, I got a lot of people in the U.S. change jobs frequently, but they leave their 401ks at the old place and just let them sit there and, let them be managed that way instead of taking them out and either getting them in an IRA, or we have this thing called a Roth IRA, and a lot of young people have been taken. I mean, I saw a guy the other day that had most of his money in a Roth IRA, which is never any taxes on it, So it's really a neat thing. It wasn't around when I started. I would have had one, but I already had an IRA, and there's, you pay when you convert, you pay the taxes. And I don't believe in paying taxes in advance, I've always had this weird hope that our government would figure it out that you shouldn't be taxing Social Security, and you shouldn't be taxing people who are pensioners and IRA people, because all that money, instead of going directly into taxes, would be going into the economy, and you'll be making that more money off businesses.
Off that. Yeah.
Yeah, instead. But they've always had a back-asswards approach to taxation. I think there used to be a thing we were trying to get through Congress called the fair tax, which was instead of it's unlike the value-added tax, but it's not an income tax. It's just a consumption tax. When you spend money on anything other than food, shelter, and clothing, there's a tax.
Yeah.
And if you're below a certain income level, you don't pay it. So it's it would really, I think it would really work well, but it doesn't have a chance. So it's been in Congress for 30, 40 years. Never gets any attention. The politicians never even talk about it, but it's been there.
Yeah.
Anyway.
And then it's about finding a way, isn't it? On an individual level, it's about finding a way to deal with how the tax system is. And,
and how to avoid them.
And learning it and how to avoid it. Yeah.
And you get some, super big, and I love corporate entities and corporations, and I love what they do. But the idea that they don't pay taxes as much as I pay bothers me. That I paid more in taxes last year than one of the presidential candidates. So I don't like that.
Well, and I had and it's the whole thing, isn't it? I did a client summit last summer, and Floris came over from Amsterdam to coach on it, and he said, there's an Amazon. He drove past. There's a huge Amazon warehouse on one of the main motorways on the way into Wales. That is a distribution center for most of the southwest. And he said, "Yeah, it's great. They don't pay any tax. So you spend all your money in the community because it's to your local Amazon, but then all of that profit and no tax, it's gone. So we have this enormous convenience, but actually the money's not staying. And this that idea that the tax goes, it's crazy. And I'd never looked at it like that before, because you think I'm all in for people making money, for corporations, for all of that, but then realizing the downside when our governments don't have the fact that the tax stays in the community because there wasn't any paid in the first place. So all of that money is just sucked out like a vacuum. And it is what it is, but changing it, I think, is probably not a game I have enough years on the planet to win.
Yeah, I certainly don't. If I get another 10 or 12, I'll be happy.
Well, and if you keep going like this, you'll have lots more, I'm sure. It's keeping busy. I have a few ideas. I'd love to speak to you again soon. I'd love to try some of your stuff. So I'm gonna appear in your Facebook groups, and there's a couple of people in my community that I would love to speak to. And there's a couple of people I'm going to speak to, and if you're looking for other podcasts and conversations, there's a SaaS group that I'm part of that's the self-invested pensions, but on a property side. But they have a lot of conversations about money and investing, and have other speakers coming in for people who aren't in property. So there may be a link.
What does in proxy mean?
In property, so pensions, but investing in property. Not in proxy, in property.
Property.
Yeah.
Okay.
So that they got their own pension, but then 50% of that can be invested, into property, and so it's very attractive for people who are in property, who want to keep their money in property, who don't really want a traditional pension. It's kind of sits in the middle ground of having another vehicle that is a more traditional pension, but has some usability. Because that the biggest, I think, pull for all of us that are in property, until we get to a place where I'm at, is I don't want to put my money anywhere else. I want to keep, putting it back into property. So the market always comes up with vehicles, doesn't it? When there's people going, no, I don't want to keep it in property. The market goes, okay, here's a pension where you can 50% of it you can put back in your own property and you can control it. So there's a group that sounds very much, it sounds very much like the ethos of your Facebook group, where people are having conversations and they're interested and they're sharing information and they're not spamming and they're not selling, and the same kind of values and principles. So I'd love to, I'm going to speak to them about, seeing if there's a connection that I can make for you there, that you can maybe do a talk or something.
Thanks. Sure.
If you're coming to Europe, like, come and visit us, and we'll organize some in-person stuff. But I'm sure
I was just your way. Last year or the year before, we were both in Scotland and in Ireland, nearby, and we're talking about it. I have our closest friends here is a Ford guy, an ex-Ford guy, and he used to manage the Ford operation in England.
Yeah,
and
brilliant.
They're talking about coming back, and I said, well, take us with you, because we've only seen London. We've never seen anything else other than what we see on BritBox. Is pretty much our that's where we spend most of our television time, is watching stuff, and I've seen a lot of the landscape outside of London doing that, but we haven't been back. We haven't been back in London and England for years and years. It must be 15, 20 years since we've been in England.
Yeah. Well, let us know,
because we will be back. We will be back.
We just had in my so we had Tad Hargrave. So his he does marketing for hippies as his brand. He's from Canada. And he came over to a summer camp that I go to in Hastings, and he ended up doing a tour all around the UK just by connecting with a few of us. We put on groups, and he came along and then did talks, and he ended up all over the UK.
Wow.
So, if you fancy doing a mini tour along with a holiday, like really do stay in touch, because there's a lot of communities that, I can introduce you to, and I'm sure you'll end up speaking to other people from the UK, and come and do some.
I expect to. Yeah, I'm about to do my second Australian podcast soon.
Yeah.
And I've been to India, and I've been to Austria. My podcast. I've been all over the place without any jet lag. It's wonderful.
Yeah, amazing. Well, you could do a world tour, never mind a European tour.
Sure.
Because it's amazing, and it was Tad that was saying about hub marketing, and actually like going to places where there were already people interested in what you're doing, and.
Yeah.
When he pulled this off, I was like, wow, that's, because you do it on a podcast, and you think, oh, that's okay. But actually doing it in person as well is
right.
It's amazing. Yeah. So any way I can support you, and, if you do come this way, I would absolutely love to. And I'm always so grateful for your time and attention, and like coming on, and anyone listening as well, like listening to this conversation. I think it's world changing. These conversations where people get to speak and listen to someone with your expertise and your knowledge, going, well, actually, if you do this, and here's my book. I'm just really grateful for your sharing.
And I too. It's been a great conversation, and I enjoyed it very much.
Yeah, fantastic. Any final thoughts? Any particular place you want people to find you? We'll put all the links in all the places this then appears. But any final thoughts, or
if they want coaching, theincomecoach.net. I'll talk to them.
Okay.
For sure. But if they read the book, they can have a choice of going directly to me, using the Facebook groups, or just going out there and talking to their own professional and say, hey, buddy, this is what I want to do.
Yeah, that's great. So the book is the best place to start, is what I'm hearing. It's like start there, because that's all of your like base stuff.
Yeah, and if you really love it, you might want to give me a call or join the groups or do it yourself. So it's up to you. It's up to you. The information's there. And I really think, and really, I was doing non-closed-end fund investing for more than half of my career. I was using individual stocks, and I was doing it, but I was doing it with the same rules, the same approach, the same market value or market cycle attentions, and the same focus on income and capital. So that approach applies to any kind of investing you do.
Yeah. So it sounds like a brilliant place to start.
Good starter place.
Yeah.
Whatever level you happen to be.
Yeah, which is relieving when it's such a massive, complex, huge.
Yeah, there's so much out there. There's so many hundreds, thousands of possibilities that you could say, I'm going to put my money in. But this approach gives you a taste of all of that, all this, all the different stocks, all the different bonds and things like that in packages that also provide you a lot of income while you're waiting for them to go up in price to sell. So it's become my home, and I started out there in the streets with the other guys. So
brilliant. Thank you so much, Steve, and I look forward to speaking to you again soon. And thank you for listening, everyone. Thanks, Steve. Bye, everybody.